Welcome to the mastery course of the world's one of the most powerful and effective price action based trading strategy, which called the advanced swing trading strategy. Who is seeking to have a powerful as well as a complete profitable trading strategy which really worthy to learn and follow to win each and every single possible trade being triggered in the market. Swing trading is the other name of the trend trading. If you open up your charting software, then you will notice that almost 80% of the time, either the market is trending upward or at the downward direction. And you might already know the saying that the trend is your friend. So why not master and get the most out of the trends? So in this course of the Mastering the Advanced Swing Trading Strategy, I will teach you each and every single details that is necessary to successfully trade the swings of a trend. Before diving into the strategy, I will first teach you the essential price action basics, especially designed to strengthen your knowledge base to make you understand the sentiment of a trend. Then I will teach you the strategy for the valid swing points as well as the invalid swing points of a trend. To successfully trade the trend, you must need to master not only the valid swing points but also need to learn how to deal with the complex looking invalid swing points of a trend. And some other important things relate to this course. So by the end of this course, you will be able to successfully make winning trades by reading the market sentiment of a trend, no matter how complex a trend setup you face in the market. The ideal students for this course is a person who has the basic knowledge of the forex or stock market trading and wants to expand or improve their current skills by learning the one of the world's most profitable price action based trading strategy. No special requirements are necessary to enroll, just come open-minded and ready to learn. To learn more about the course, feel free to look through the course curriculum and more on the course description. So we'll see you in the course inside. Hello traders, welcome back. There are many traders who knows the basic rules and method of forex trading, but still they have a little confusion about the topic of price action and price action based strategies. So in this lecture today, I will explain you what actually the price action is in terms of forex trading and what the price action based strategies are. Since this course is about a very popular price action based strategy, so it's important to understand the basic idea of price action and price action based strategies. So let's start. Price action is actually the movement of the price of a security like currencies, stocks, bonds, commodities, futures, etc. We can see a security's price action or its price movement using the numbers and figures. But when we see the price movement of a certain security using graphical illustration like line charts, standard bar charts, or the Japanese candlestick charts, then we call this whole setup as price action chart. In forex and stock market, candlestick-based price action charts are very famous since its graphical representation of the price movement of a security is very easy and simple to understand. In candlestick-based price action chart, every single bar is called as candlestick since its basic figure looks like a candle. A candlestick of a security represents its price movement in a certain period of time. As you can see, this is a day chart. So here, every single candlestick represents the movement of price during that day. This chart is showing the price action of 56 trading days. That means from November 8 of 2012 to February 4 of 2013. In this chart, price rose up and made an uptrend, which is more than 1000 pips. It's huge, right? Now, traders who trade the market by analyzing the candles of a price action chart, we call them as price action trader, and the analysis process of trading the price action is called the technical analysis. There are many strategies have been made just based on the technical analysis. If someone develop a trading rule that when to enter into the market, where to place the stop loss, and where to look for profit using a disciplined capital management system, then they are actually following a trading strategy. A trading strategy allows someone to be disciplined about following a trading method using some specific rule to get success on trades. So let's say you know very well about the candlestick patterns. Now, if you develop a strategy just based on some strong candlestick patterns, then you are a price action trader who follows a price action based strategy where your every trade setup depends on the candlesticks only. That means you will enter into the market only if you see a strong candlestick pattern in a price action chart. You have developed your strategy or trading method that where to place a trade entry, where to place the stop loss, how far you will set your targeted profit level, and the other relevant things. On the same way, if someone develops a strategy just based on some specific price action patterns, like the head and shoulder price action patterns or the double top pattern, then they are also following a strategy where they only enters into the market whenever they will see a double top or a head and shoulder pattern. They know it very well on which point they should have to trigger a trade and where to place the stop loss and take profit levels. So they are the price action traders who has a price action based strategy where they only trade certain price action patterns. So those people who trade the market by analyzing the price actions in a chart, they are the price action traders and also as well as are the technical analysts. So having a good trading strategy and then following every single rules and be disciplined about that strategy is very important to become successful in trading the securities. So in this course, you will learn a very popular and reliable price action based strategy which has adopted by most of the professional and successful price action traders. And the strategy is called the swing trading strategy. In swing trading, we focus only on the trends. Either it's an uptrend or downtrend in a price action chart. Approximately more than 80% of the time, you will see the market is trending either on upward direction or in the downward direction. And the trend is happening almost in all the major currency pairs and in stock market charts. So why not trading the trends? As you may have heard the saying that trend is your friend. So in this strategy, I will only talk about the trend trading. You will learn almost everything to trade the trends, no matter how complex a trend looks like to you. So I hope you will watch every lecture in this course, since everything I will tell you during the lectures in the whole course is very well organized and relevant to the subject. So I am signing off for today. Hope you enjoyed the lecture. See you in the next video. Till then, have a nice day and goodbye. Welcome back, traders. What's going on? In the previous lecture, I talked about the price action and strategies based on the price action charts. Now from this lecture on to the next couple of lectures, I will be talking to you about one of the most important topic of the price action based technical analysis, which is the support and resistance level. Support and resistance are one of the most effective and reliable concepts of trading the securities to analyze the market as a technical analyst. To learn very well about the support and resistance level on a price action chart, you first need to learn the basic concept of the demand and supply theory. By the time you become familiar with the basics of the demand and supply theory, you will come to realize the true meaning of the support and resistance level on a price action chart. So in this lecture, I will give you a brief explanation about understanding the demand and supply on a price action chart. So let's discuss about what the demand and supply really means, which are the main forces to execute the market. Demand in economics is the quantity of a product, commodity, security or a service that people are willing to buy at a certain price. For example, when you want to buy a jar of milk for $5, then you have created the demand of milk to be sold at the price of $5. On the other hand, supply is the amount of something that firms, consumers, providers of financial assets, or other economic agents are willing to provide to the marketplace. For example, for the demand of a jar of milk, a farmer would be willing to produce or supply a jar of milk at the price of $5. Demand and supply both has the inverse relationship of between the price and quantity, which called the theory of demand and supply. According to this theory of demand, when the price of a product, asset or security falls down, the quantity of buyers will increase. That means if the price of a product is low, then the demand will increase and more people would be willing to buy that product at the lower price. On the other hand, if the price of a product is high, then the demand of that product will decrease and hence less people would be willing to purchase that product. For example, if the price of milk become low or cheap, then the demand of milk will increase, for which more buyers would be willing to buy milk. On the other hand, if the price of milk become high or expensive, then the demand of milk will decrease, for which less number of buyers would be willing to buy that milk. On the exact same but opposite way, according to the theory of supply, when the price of a product or security rises up, the quantity of sellers will increase. That means if the price of a product is high, then the supply of that product will increase, while more people would be willing to produce and sell that product for higher price. On the other hand, if the price of a product is low, then the supply of that product will decrease because no one would be willing to produce and sell a product at lower price. For example, if the price of milk become high or expensive, then the supply of milk will be increased since the farmers would be willing to produce more milk to earn good amount of money. On the other hand, if the price of milk become low or cheap, then the supply of milk will decrease because no one would be willing to produce milk to sell it at the lower price. So that's the basics of the demand and supply theory. This theory can be applied in almost all the fields where the buyers meets the sellers in the market. Now let me explain this theory more in the perspective of trading the securities. So let's say in a price action chart of a security, the current price is at the high or peak of the market. So the high price will create higher supply as because that higher price will attract more sellers to supply or sell at the market. While on the other hand, according to the inverse theory of demand and supply, this higher price will create a low demand for the buyers and hence discourage them to buy at the expensive price. So here, the number of the sellers or the suppliers will increase and the number of buyers will decrease in volume. And for that extreme selling pressure, the market price will start to decrease as because the price of a product depreciates over time if there are more supply of a product than the demand of that product in a market. So if the price of a product or security become low or cheap, then that would decrease the supply of that product or security. While on the other hand, the demand would be increased because more buyers would be willing to buy that product or security at the lower market price. And that demand will cause an extreme buying pressure on the market for which the price will rise up, and then again the price will be depreciated over time since the rising higher price will attract more sellers to come into the market as the higher price creates higher supply. So in summary, when price falls down, then the demand or buying pressure will increase over the sellers. So that increasing buying pressure will lead the market to rise up, and then over time the demand of the buying will decrease while the supply of the market will increase in volume. So that selling pressure over the buyers will cause the price to fall down. And then again at a certain price level, when the price will depreciate on the market, that will create more demand and less supply for which the market will rise again because of the extreme buying pressure. So this loop of the demand and supply or the trades from the buyers and sellers continuously runs in the market. So in this course, every time I will mention of the bottom or swing low point, it actually means the demand of the market. On the same way, the tops or swing high points will be referred as the supply of the market. So that's the basic of the demand and supply on a price action chart, which is the main force to execute the market of a security. In the next lecture, I will talk about the support and resistance levels in terms of the demand and supply of a security. So that's all for now. We'll see you in the next lecture. Till then, have a nice day and goodbye. Welcome back traders, what's going on? In the previous lecture, you have learned about the demand and supply theory, which is the main force to execute the market. Now in this lecture today, I will be talking to you about the support and resistance level on a price action chart. At first, we will talk about the support on a price action chart. Support is a specific price zone or area where the selling pressure becomes very weak as because the supply of the market decreases as well as the demand increases, so that the buying pressure becomes stronger over the selling pressure and hence the price changes its direction to rise up from the support level. So after a bearish rally, if the price rises up by creating a very bottom level, then that bottom level or swing low point becomes a support on that price action chart. The significance of the support level is that if again the market run into the bearish momentum and price falls down, then the possibilities are high that the price will retest the previous support level and then without breaking the previous support and falling further below that level, Rather, price will rise up again by creating another bottom or support level on the previous support zone. Supports are the price zone where we should look for the signal to trigger long trade entry. Now let's have a real chart example for these types of price action setup. As you can see, this is a 4-hour chart of Euro versus Japan Yen. Here you will notice that there is a price zone which was the lowest price level of the market for several times. From the top of this chart, price falls down until a specific price zone which we call as the support level. Then after hitting that support level, price rose up without breaking and going further below of that support level. These support levels prevented price to fall more down. The strength of a support level depends on the number of how many times the level was retested. As you can see, in this chart we have 3 support levels on one price zone. That means at least 3 times price has retested this zone and tried to break the level to fall more down. But it could not do that until the 4th attempt, when finally price broke the support level and went further down. So this was a strong support zone for a very long time. Support is not an exact price level, rather it's a zone or area where sellers tend to close their trades. In these levels, because of the lower price, the sellers psychologically become weak, so they start to close their trades, which increases the demand of the market and hence give the space to the buyers to go for long trade entries. That's why these are the area where you will find the best long trade opportunity in the market. Now let's discuss about the resistance on a price action chart. Resistance is the exact opposite thing of the support on a price action chart, while resistance is a price zone where the market tends to lose buying pressure because of the higher market price according to the theory of demand and supply. So because of the increasing supply or selling pressure, the price falls down after hitting the resistance zone. Basically, resistance are the swing high points or the top levels on a price action chart. So in general, whenever price comes near to the previous resistance zone, there are no demand can be seen in the market to show the buying pressure. So at that time, selling pressure becomes so strong that the price falls down after retesting the resistance level. This loop of the retesting the resistance level and then the price turning back again and again can be seen very often on a price action chart. But if the price can break the resistance level, then that would mean that the demand is still greater than the supply of the market, which drives the price to go more up. Now let me give you an example of this setup using real price action chart. As you can see, this is a day chart of Australian dollar versus US dollar. Here you will notice a resistance zone which has been retested for at least 3 times in this price action chart. Every time price reached this zone, the market declined to go more up. It shows that by the time price came near to the resistance zone, the supply volume becomes greater than the demand of the market, and hence that extreme selling pressure took control of the market over the buyers with a larger volume of trades. So the resistance zones are the area where you will find the best signals to trigger short trade entry. So that's the basic concept of the support and resistance level on a price action chart. In the next lecture, I will tell you more details about the support and resistance level. So we'll see you there. Till then, have a nice day and goodbye. Hello traders, welcome back. In the previous lecture, you have learned about the basic characteristics of support and resistance level, where a previous bottom acted as the support for a new bottom by preventing the price to go more down from where the price changes its direction and rises up. On the same way, a previous top acted as the resistance for a new top level by preventing the price to go more up from where the price changes its direction to fall more down. In summary, you have learned that a previous bottom acts as the support for a new bottom and prevent price to go more down. On the same way, a previous top level acts as the resistance for the new top level to prevent the price to go more up. But there are some situations when a previous resistance becomes the support and hence prevent the price to go more down, as well as the previous support becomes the resistance to prevent the price to go more up. That new thing might be sound a bit confusing, but it will be clear if I explain you the setup with example. So let me first clarify this new topic about the support and resistance with the illustrated example. Then I will show you the steps with the real price action chart. So let's start. At first, we will talk about the resistance level which tend to act as the support on a price action chart. Whenever price goes up and then falls down by creating a new top level, then that new top level becomes a resistance for the upcoming market price, which prevent the price to break the zone and go more up. And the bottom, where the market loses the sellers as well as attract the buyers, we call this as the support of that market, which prevent the price to break the zone and go more down. But because the market does not stay in a certain range forever, so sooner or later the price will break the resistance and go more up, or will break the support and fall more down. Now let's say from the support on a market, because of the strong buying pressure, if the price break the resistance zone and go more up, then the resistance will become the new support for the upcoming market price action. That means if the price falls down from the top because of the selling pressure, then that resistance will act here as the new support and hence will prevent the price to go more down. So that resistance will work as the new support along with also being as the resistance level. Now notice that because the market has created a new top level, so this new top level has become the new resistance by default and will try to prevent the price to go more up by breaking that level. But let's say if the price can break this new resistance level too and go more up, then this resistance level will also turn into a new support level for the upcoming market price action, which will prevent the price to break this support level and fall more down. So that's the basic concept of how a resistance acts not only as a resistance but also as a support level. Now let's have a real chart example of these types of price action setup. As you can see, this is a 4-hour chart of Aussie dollar versus US dollar. Here you will notice that this top or swing high of the market is by default a resistance level in this price action chart. The main purpose of a resistance is to prevent the price to go more up by breaking the resistance level. But as you can see, this resistance level could not prevent the price to go up. So price rose up until it got rejected by another strong resistance level. So in this chart, price got rejected for at least 3 times to go more up by breaking this resistance zone. Every time price reached to this zone from the bottom, the buying pressure became low and hence the selling pressure became stronger, which is why price falls down from this resistance level. For the second time, when the price falls after the rejection, price went down until the previous resistance level, which prevents the price to go further down, and hence the resistance here acted as the support level. You will also notice that this support level has been respected by the market for at least one more time. Now again, when the price rose up by finally breaking the next resistance, which was a strong resistance level for a long time, has now become a support level for the next price action of the market, which prevents the price to go more down since the selling pressure decreases as well as the buying pressure increases at the lower market price, or more specifically at a strong support level. So that's how a resistance level become a support on a price action chart and hence prevent the price to go more down. Now let's discuss about the support level when it acts as the resistance on a price action chart. In a price action chart, whenever the price falls down and then rise up from the bottom, we call that bottom or swing low as a support for the upcoming market price that will prevent the price to go more down below that support level. Now if the price break the support level and fall more down, then create a new bottom level which indicates the oversold zone, then by default this new bottom will also become a support level for the upcoming price action, which will prevent the price to go more down by breaking that support level. Now since the price broke the previous support level, so that support level has now transformed into a new resistance for the upcoming market price. So if the price rise up from the current bottom, then that previous support level will now act as a resistance and hence will resist the price to go more up by breaking that resistance level. Now again, if the price fall down after getting rejected by the resistance level and then break the current support level, then this support level will also turn into a resistance for the upcoming market price and hence will prevent the price to rise more up by breaking that resistance level. So that's how a support become a resistance on a price action chart. Now let me give you an example of the setup using real price action chart. As you can see, this is a day chart of Euro versus US dollar. Here you will notice that this support has been acted as the resistance for the second bullish rally in this chart. And then the next bottom or support has worked as the resistance for two of the next back-to-back bullish rallies in this price action chart. So after the price falls down and breaks the first support level, that support now has turned into a resistance for the next price action and hence prevented the price to rise further more up by breaking the resistance level. So after the price getting rejected by the support which acted as the resistance, price falls way more down by breaking the next support level. So that support became the next resistance for the upcoming price action on this chart. Then later, price rose up for several times but could not break that resistance. Rather, the price falls down after getting rejected by the resistance, which primarily is a support on this price action chart. So in summary, every swing point, either it's a swing high or swing low, it can be a support or a resistance on a price action chart depending on its position on the market. Support and resistance are the demand and supply zones, while a resistance will resist the price to go further up and a support will prevent the price to go further down. A resistance will be turned into a support level by the time the price will go up by breaking that resistance level. On the same way, a support will be turned into a resistance level by the time the price will break that support level. To take any appropriate trading decision by analyzing the support and resistance levels on a price action chart, you don't need to analyze the very old support and resistance levels. Rather, search the newer or recent support and resistance levels on your chart. Support and resistance levels older more than 1 year is quite useless unless you face a support or resistance which has been remained strong or unbreakable for a quite long time. So that's the end for now about the support and resistance level. Hope you guys enjoyed the lesson. We'll see you in the next lecture. Till then, have a nice day and goodbye. Welcome back traders, what's going on? In this lecture today, I will be talking to you about how to detect a valid top and bottom. I got emails from some of the traders asking me to give them suggestions by looking their losing trades. They wanted me to tell them what they are doing wrong. And believe me, most of them have one common problem. And that is, they take trade entries in invalid tops and bottoms without knowing the different trading rules for both the valids and invalids. Not all the tops and bottoms are beautifully formed and ideal to trade. So understanding the basic structure and characteristics of valid and invalid tops and bottoms is essential for a swing trader. So how to identify a valid top and bottom? The answer is, to be considered as a valid top, at least 3 healthy bullish candles should be appear from the bottom of a price action chart. On the same way, at least 3 bearish candles should be appear in a price action chart to be called a valid bottom. By speaking healthy candle, I mean the opening and closing price of a candle should have some significant level of price gaps. That means candle bodies should be greater than the shadows or wicks of the candle in size. The same things is applicable for bearish candle to consider it a healthy candlestick. The reason we need at least 3 healthy bullish candlesticks to make a valid top is because whenever 3 healthy bullish candlestick forms, price goes up and creates a significant level of price distance, which shows the validity of that rally. Now, the same price distance can be achieved by 4, 5 or more small and unhealthy candlesticks too. These setups also makes a valid top. The thing we need is just the price distance from a bottom to top. But remember, we need at least 2 candlesticks to make a valid top. If a large candle alone appears with a significant level of price distance, then that does not mean we have a valid top. We must need at least 2 healthy bullish candlesticks to call something a valid top. And the same setting is applicable for bearish candles to make a valid bottom by going down for a significant level of price distance. The same distance can be achieved by even small and unhealthy candlesticks too. Still, it's a valid bottom, though this time we will need more candlesticks to form for a valid bottom level. That means if price goes up by making at least 3 healthy bullish candlesticks in every upward rally, then these rallies will make a valid top. Likewise, if price goes down by making at least 3 healthy bearish candlesticks from a valid top, then they will make a valid bottom level. Which means if an uptrend continues its journey by making continuous valid tops and bottoms, then this is an ideal and standard trend formation in a price action chart. No matter how many candles are there and how a candle look like, as long as they achieve a certain level of price distance, we will call them valid tops and bottoms. Although not all the trend is made by all valid tops and bottoms. You will have so many invalid tops and bottoms in a trend, and the trend will continue its journey with invalid tops and bottoms. But still, we will compare them with valid tops and bottoms, because if you learn the right ones, then you can debug or filter the odd ones in a trade setup. But don't worry, you will learn trading both the valid and invalids of a trend throughout this course. The exact same but opposite setup is applicable for downtrend market. If from every bottom to top and every top to bottom, we see some significant level of price distance, then we can call them as valid tops and bottoms. No matter how many candles it took to achieve that price distance and what types of candles has formed, we will call them as valid tops and bottoms. But again, remember, you will not find valid tops and bottoms all the time. You will see the mixture of valid and invalid tops and bottoms in a trend. So, learning the both will make yourself easier to decide whether you should take a trade or not, and if you should, then which strategy you will follow to trade them. You must be wondering that why I am giving so much importance to them. Is it really that necessary to learn and identify them? No, this is not necessary, but rather it's essential, because these are the levels from where price takes reversal or change its running direction. So it is very important for a trader to identify these levels so that he or she can enter in a trade as early as it possible by following a good trading strategy which ensures greater profit with lesser risk. So having good knowledge about the validity and invalidity of a top and bottom is essential to trade the market as a price action trader. Let me give you a real chart example of this. This is a 4-hour chart of pound versus US dollar, and as you can see, the market is trending upward in this chart, where almost all the tops and bottoms are valid. All the tops and bottoms were made by at least 3 or more healthy candlesticks in this chart, except this one here. The top here is a valid top since it forms after more than 3 healthy candlesticks, but the bottom is not valid. It's an invalid bottom, because we can't even see a single healthy bearish candle where we need at least 3. You may say that we don't need healthy bearish candle here to form a valid bottom. The market was consolidating, which we can see with some dodgy candlesticks over here, and we could trade long after this bullish candle at this price consolidation stage. Well, you can say that because you are watching a chart which has already been made. It's not that easy to trade these types of trade setups in live charts. Let's say if I remove the rest of the price actions of this chart so you can feel that you are watching a live price actions in the market, and if you say that the market is consolidating, well, that's true, but if we wait for the next candle, you can see that this bullish candle has formed after some dodgy candlesticks. And if you are a candlestick trader, then you may think that the market is going to rise again, because the bullish candle here indicates the buying pressure after the long fight with the sellers, which we can see through the dodgy candlesticks. And let's say you have placed a long trade entry after the bullish candle at this invalid bottom, and then placed a stop loss at 3 pips below the lowest price of this invalid bottom. So you are trading at the invalid bottom level, right? Fine. Now, if I uncover some more candles after that trade, you can see price goes a little bit higher. But this pin bar has stopped you out as its tail hits your stop loss. So it's a lost trade here. Well, you may say that these kinds of spikes happens in the market all the time. So a loss is a part of the game. Well, you are still true. But if I again uncover the rest of the chart price action, then you can see the market came down to make a very bottom level and then hits your stop loss again. So you stopped out with stop loss hit for 2 times, and the second one is a valid hit. both the valid and invalid tops and bottoms have different trading strategy. So if you don't follow the rule of trading the valid and invalid tops and bottoms, then you deserve these kinds of stop losses. I agree that losses are the part of the game, but why taking losses when you can survive them by taking appropriate trading decisions at the right positions of the market? We can survive most of the trades and gain a good amount of profit if we maintain the discipline of trading the trend by filtering the odds from the good ones. That's why at the first step of trading the trend, this is very important that you understand the basic idea of the valid and invalid tops and bottoms. But don't worry, I will teach you even how to trade the invalid tops and bottoms as well in the strategy section. So that's the end for today. Hope you guys enjoyed the lecture and thank you very much for watching this video. Ask me anything regarding this lecture in the comment section. I will love to answer them. So we'll see you in the next lecture. Till then, goodbye and have a nice day. Hello traders, welcome back. In the previous lecture, I have discussed about the basic structure of valid and invalid tops and bottoms in a price action chart. And in this lecture today, I will be talking to you about the swing points. The term swing point is basically being used for swing trading. In a trending market, whether it's an uptrend or downtrend, price goes into a specific direction, or maybe we can say at the current trend direction by continuously making the tops and bottoms. All the tops and bottoms are the swing points of a trend. If a top of a trend is a valid top, then we call this as valid swing point. And if the top is invalid top, then we call this as invalid swing point. Likewise, if the bottom is valid, then we call this a valid swing point, and if the bottom is invalid, then we call this as invalid swing point. So all the tops and bottoms, either they are valid or invalid, we will call them swing point. But to recognize them as their kind of formation, we call the top swing points as swing high and the bottom swing points as swing low. These are the very important levels. There we make the trading decisions like whether we should take a long trade entry or a short trade entry. These levels or swing points are also important to getting out of a trade at the right time by taking the profits. Swing points are mainly four types based on uptrend and downtrend in the market. In an uptrend market, where price goes higher and higher by making continuous tops and bottoms, we call the top swing points as higher high, since every swing point or swing high is higher than the previous one. And we call the bottom swing points as higher low, since every bottom swing points or swing low is higher than the previous one. In an uptrend, the higher highs are the levels from where price consolidation begins. We also call this as the retracement point. Price goes down from the top swing points or higher highs to create a new higher low or bottom swing point. So bottom swing point or higher lows are the levels from where the market gets enough buying pressure to continue the trend again. That's why higher low levels are the best place to trade long. Our strategies, one of the main goal is to identify a trend's higher low levels to trigger long trade entries as early as it possible. Remember one thing very carefully, that an uptrend is valid until every higher high is higher than the previous higher high and every higher low is higher than the previous higher low. That's the way we can tell that the upward momentum of the uptrend is still running strong. On the other hand, the top swing points are called the lower high levels of a downtrend market, since the top swing points are the highest level of a downtrend which goes lower and lower by the time. And the bottom swing points are called the lower lows in a downtrend market, since every bottom swing points of a downtrend market is the lowest level of that downtrend as price goes more lower and lower by the time. The lower lows of a downtrend are the points from where price starts to consolidate by going up for a retracement, and the lower highs are the points from where sellers get enough strength as volume so that traders can understand that the retracement is over. Hence, the downtrend continues its journey. That's why the lower high points or the top swing points of a downtrend market are the area where we will look up for short trade entries, because as early as we can catch the rally of a trend, our chances will be increased to win a trade with maximum profit. And again, the momentum of a downtrend is strong or valid until every lower high of a downtrend is lower than the previous lower high, and every lower low level is lower than the previous lower low. So now let's make a tour to the real trading platform and recognize the higher highs and higher lows in the uptrend market and lower highs and lower lows in the downtrend market. As you can see, this is a day chart of pound versus yen, and you will notice that the market is trending upward on this chart by making continuous tops and bottoms. The tops in this chart or the swing high points are the higher highs of this uptrend, and the bottoms or swing lows of this chart are the higher lows of this uptrend. And you can see every higher high point has formed above its previous higher high point. On the same way, every higher low point has formed above the previous higher low point. When all the higher high forms above the previous higher high and all the higher low forms above the previous higher low, this gives the indication that the market is completely under control of the buyers. But when a swing high point can't breach the previous higher high and the swing low also fails to stay above the previous higher low, then this kinds of setup indicates that the end of the uptrend is coming ahead. You will learn more on this in a later section where I will talk about how to detect the end of a trend as well as other relevant things on this topic. Now let's have another example. This is a day chart of USD CAD, and you can see that the market is trending downward on this chart by making continuous tops and bottoms or swing high and swing lows. Now, in terms of swing trading, all the tops in this downtrend market, we call them the lower highs as they are the highest point of this downtrend market, and all the bottoms of this downtrend, we call them the lower lows as they are the lowest point of this downtrend market. And you can also notice that every lower high has formed below its preceding lower high level, and every lower low has formed below its preceding lower low level, which makes the downtrend momentum more stable to trade. This is not essential for every lower high and lower low to form below their preceding lower high and lower low, but it's very important that both back-to-back lower high and lower low points should not form above their preceding lower high and lower low at the same time. Otherwise, it will indicate the end of the downtrend momentum in the near future. So that was the end for today. I am signing off for now. Hope you guys enjoyed the lecture. We'll see you in the next class. Till then, goodbye and have a nice day. Hello traders, welcome back. In the previous lecture, you have learned the basics of swing points in a trend. And in this lecture today, I will be talking to you about the basic structure and method of standard risk and reward ratio model. This lecture will show you the standard structure of risk and reward ratio model, which you can use in almost every strategy you will find. Risk and reward ratio is basically being used for forex and stock market trading. Without the understanding and managing the risk of your trading, it is nearly impossible to earn consistent reward in your trading career. So let's start knowing what are the risk and reward ratio model is and how to apply that in your everyday trading checklist. So what is the risk and reward ratio model? When you aim to invest your capital in certain trade of a security like forex or stock to have a certain amount of profit from the trade as return and the amount you are agreed to take risk as a loss if your trade goes against you, then the mathematical ratio between the size of the risk and reward is called the risk and reward ratio model. Let me give you an example of this. Let's say you have opened a trade at $40 market price. You expect that the price will rise at $60. Now you are willing to have $20 return as profit if price goes in your targeted direction, but there are chances that the price will go down and make you lose. So you will tolerate until market price goes at $30, and if price touches 30, then you will close your trade by taking $10 loss, which means you are willing to risk $10 to get $20. So your reward is twice the size of your risk. That's why your risk versus reward ratio is 1:2. Again, if you wish to have $30 profit per share using the same $10 risk, then the market will have to rise from 40 to 70. That will give you a reward of $30 against the risk of $10. That means you're using 1:3 risk and reward ratio model. But remember, you should never trade on something for getting same amount of reward as profit by taking the same amount of risk, which means your risk and reward ratio should never be 1:1. So never trade to get $10 by risking 10. Always put your invest on something which gives you profit for at least double of your risk. your risk and reward ratio can be extended by up to 1:10 or even more with swing trading. That's why I personally like trading the trends. You will learn more about this in later lectures, but I am signing off for today. Hope you guys enjoyed the lecture. So see you in the next class. Goodbye and have a nice day. Hello traders, welcome back. This is the very first lecture of the strategy section. In this section, you will learn the swing trading strategy for varied swing points. In the first 5 lectures on this section, you will learn about the basics of swing trading strategy, and then from the 6th lecture on to until the end of this course, you will learn the advancement of the swing trading strategy. So let's begin to know the swing trading strategy from the very basics. To trade the varied swing points, we will be focusing on 3 main steps. The first step is to finding a trend. Either it's an uptrend on a price action chart or a downtrend in a price action chart. The second step is to finding varied trading points on that trend. That means finding the higher low points in an uptrend market and lower high points in a downtrend market. As you already know from the previous lectures that the higher low levels are the trading points of an uptrend market and the lower high levels are the trading points of a downtrend market. And the third step is to finding strong candlestick pattern at the trading point of a trend. That means search a strong bullish candlestick pattern on the higher low point of an uptrend market which acts as a trend reversal pattern, like the bullish pin bar pattern or the engulfing candlestick pattern or any other strong candlestick patterns, so that we can confirm the end of the running bearish momentum and have the trade confirmation of the upcoming bullish momentum. On the same way, search a strong bearish candlestick pattern on the lower high point of a downtrend market. A strong bearish candlestick pattern on the lower high levels of a downtrend market indicates the end of the bullish momentum on that downtrend and predicts the upcoming bearish market momentum, which we intend to catch as early as it possible. Now, before explaining the main steps, let me warn you one thing first, which is very important, and that is never place a short trade entry in the uptrend market and never place a long trade entry in the downtrend market, because uptrend market is only valid for long trade entries but not for the short trade entries. On the same way, downtrend market is only valid for short trade entries but not for the long trade entries. Write these lines on a paper note and stick it in front of your trading desk. You should never break this rule until you have enough knowledge to trade the trends. There are so many traders who blows up all of their trading capital in a trendy market just because they place trade entries in every swing point they see in the market. But you must not do that. Instead, wait for the exact signal to trade long or short. Now let's explain the main steps with further details. For the first step, we need to look up for a trend. To identify trends, traders generally use indicators like moving averages, Bollinger Bands, and other trend identifying lagging indicators. But before you use any indicators in your chart, you need to have some logical trend confirmation signal in your price action chart. Moving averages are good for the eyes, but this does not always help to detect a valid trend. So how to spot a trend? Well, I have my own version to do that in a more simple way. At first, look at your chart. If the price is going towards the upward direction by making continuous higher highs and higher lows, then you are facing an uptrend momentum on that security. And if the price is going towards the downward direction by continuously making the lower highs and lower lows, then you are in a downtrend market. You will learn more about the trend confirmation in the next lecture, but for now, just concentrate on the main steps that we are going to need to trade the trends. Now, for the second step, we need to spot the trading points. Trading points are the area from where price starts to gain power to resume the current trend after completing the retracement. So we will look for the trading points to place our trade entries. So to trade in the uptrend market, always look for a higher low point where you can place your long trade entry. So higher low levels are the trading points in an uptrend market. And let me remind you again that never place a short trade entry in an uptrend market. Uptrend markets are valid for the long trades only. And to trade in the downtrend market, always look for the lower high levels since these are the trading points of a downtrend market. So we will only trade short at the lower high levels of a downtrend market. And again, remember that downtrends are only valid for short trade entries. Never trigger any long trade entry in a downtrend market unless you gather enough experience to trade the market as a price action trader. And now for the third step, to trade in a trendy market, always wait for until you find a strong trend reversal candlestick pattern at the trading point of a trend. In an uptrend market, wait for any of the strong bullish candlestick pattern to form at the higher low levels to trigger long trade entry. On the same way, to trade in a downtrend market, wait for any of the strong bearish candlestick pattern to form at the lower high points to trigger short trade entry. So these are the three main steps to trade in a trendy market. These types of trade setup carries the highest level of chance to win a trade. Because when you trigger a trade entry by following these three steps, then that means you have triggered your trade in the direction of the running trend. So you are actually trading with the majority of the traders on that market. And the trade in the trading point makes sure that you have triggered your trade from the very beginning of the push from the retracement level, so that your stop loss becomes small and the take profit level becomes very large. And then finally, a strong candlestick pattern gives you the confirmation of the end of the retracement and hence indicates that the market is going to move in your trading direction. So these are the steps you should always keep in your mind whenever you are going to trade in a trendy market. So many questions might be arising to you right now, but don't worry, I will cover all the necessary things you will need to know about swing trading, but in the next following lectures. So in the next lecture, I will tell you about the trend confirmation method using real chart examples. So we'll see you in the next lecture. Until then, have a nice day and goodbye. Welcome back traders, what's going on? In the previous lecture, I have discussed about three main steps to look up for swing trade setup in the valid swing points of a trend. And in this lecture today, I will be talking to you about the trend confirmation method, which is the first step we need to confirm in order to trigger a trade. There is a simple yet very confusing question arises when traders try to detect a trend when the trend is just started to form. You might already know that continuous higher highs and higher lows indicates an uptrend and continuous lower highs and lower lows indicates a downtrend in the market. But how many higher highs and higher lows do we need to confirm an uptrend, and how many lower highs and lower lows are needed to form to be called as a downtrend in a price action chart? It is very important to have a method by which we can confirm the direction of a trend as early as it possible, because in the middle of a trend it's a bit easier to identify a trend's direction with bare eyes or using any trend detecting indicators like moving average. But at the early stage of a trend formation, it's quite difficult to confirm and predict its upcoming direction. You will get more profitable as early as you can catch the trend of a market. So how to do that? It's very simple actually. To have the confirmation of an uptrend, wait for until two higher highs and two higher lows to form in the price action chart. So if we have two back-to-back higher highs and higher lows in a price action chart, then this setup indicates that the new uptrend has confirmed and the market may follow the direction of this newborn trend. Now another question can be arised that from which swing point should we start counting the higher lows and higher highs? Because at the beginning of a trend, it's very confusing to label them. So here comes the tricky yet simple part. Always remember that the lowest price level or the lowest swing point is the higher low one. Then from this bottom level, if price goes up and create a new top level, then we will consider this new top as a higher high one. This is not necessary for the first higher high to break the previous top, but if price can break the previous high, then this would be a more strong indication for the uptrend confirmation. And then when price goes down for a retracement and create a new bottom level above the higher low one, then this current bottom level would be considered as higher low 2. So until now we have two higher lows and one higher high in this price action chart. To confirm the uptrend of the market, we need one more higher high to form. So if price goes up and break the higher high level 1 and create a new top, then we will call this new top level as higher high 2. Now that we have two higher highs and two higher lows in this price action chart, so we are pretty much confirmed that the uptrend has begun. Although we can't say how long an uptrend will remain intact after it formed, but if you have at least two higher lows and two higher highs in a price action chart, then this indicates that you are watching an uptrend market in a price action chart, which can lead the price to go up for a very long time. And let me remind you again that higher low level 2 must form above the higher low level 1 and higher high level 2 must form above the higher high level 1 and so on. You can take a look back on the lecture of swing point in the second section where I explained all the necessary details about the higher highs and higher lows in a price action chart. Now as we assume that we have two higher lows and two higher highs in a price action chart, which gives us the confirmation of the new uptrend momentum, it's time to enter in the market and play with this new uptrend. So to trigger long trade entry, wait for the next retracement from the higher high 2 to make a new bottom level, as we always search long trade opportunity only at the bottom levels. And by the time the market creates a new bottom level above the higher low 2, we will call this new bottom as a higher low 3. So since we have our uptrend confirmation and a valid higher low to trade, the only thing we need now is a strong bullish candlestick pattern to enter for a long trade entry. And if you find a strong bullish candlestick pattern at the higher low level 3, then you can place your very first long trade entry after that candle and make some serious profit with the new uptrend. So in summary, you will need to wait for 2 higher lows and 2 higher highs to confirm an uptrend, and after you have the uptrend confirmation, you can trigger long trade entries from the third higher low level to every next higher low levels if you find a strong bullish candlestick pattern at that higher low level. I can understand if you feel confused about this whole concept, but you don't need to worry because you will have so many real chart examples with this concept in the upcoming lectures, so that it will become a piece of cake for you even before you finish the course. So in the next lecture, I will give you a brief lecture about the uptrend confirmation method using real chart examples, since everything we're learning is for to trade in the real market. So we'll see you in the next lecture. Till then, goodbye and have a nice day. Hello traders, welcome back. In the previous lecture, I have discussed about how to detect an early formation of an uptrend and then trade the trend using swing trading strategy. Now in this lecture today, I will show you the steps of uptrend formation using real chart example. As you can see, this is a 4-hour chart of euro versus dollar. I have intentionally removed the rest of the price actions from this chart and will show you the rest of the price actions of this chart step by step as I explain you the strategy further ahead. Because I want you to understand the steps like you have not seen the upcoming result of the market yet. It's very time consuming to make a lecture on uptrend formation using live market charts, because a trend formation takes quite a long time. That's why I will give you examples using old price action data, but that will work fine, because as you may know that history repeats itself, and that's the core of technical analysis. So let's confirm an uptrend with the steps that you have learned in the previous lecture. As you can see, the market is now showing downtrend momentum on this currency pair, and this bottom level is the lowest price level on this Euro USD chart. Now if price goes up from this bottom level and make an uptrend, then this bottom level would be our higher low level 1. So let's see what happened next. And as you can see, price rose up from the bottom level and made a new valid top, which you can see with a bearish pin bar candle with a long tail above. So we can assume that this might be the new swing high or top of the market, as the pin bar tail shows us the rejection of the bullish momentum. And let's assume that if the market continues to go up and make an uptrend, then the current bottom level would become the first higher low level. Now we can say for sure if the current top we are seeing is higher high level 1, because we don't know yet if price will go more up without making the second valid higher low point. And we can't confirm a higher high level until we have a valid bottom or higher low level. So let's wait and see what the market brings us next. And as I uncover some more price action, you can see that price continued to go up and made a new top level. So the previous pin bar's high is not the higher high one, but we're still not sure if this new high or top level is the higher high one, because price can go more up without making a valid bottom. So let's wait and see what comes next. And if I uncover some more price action, then you can see finally price went down to create a new bottom and has retraced more than 70% of the previous bullish rally. So we can call this bottom as a valid bottom if price rise up from this stage. The long tail of the most recent pin bar indicates that buyers are getting stronger over the sellers, which is why chances are huge that price will make a pullback towards the upward direction. But we will not trigger any long trades here after the pin bar, since we are still in the territory of the downtrend momentum, and we need the uptrend confirmation to go long. Now if price goes up and make a new valid top, then the pin bar's low will be considered as higher low level 2. But we are not sure if price will go further down or will go up, but we have the confirmation that the previous top is the higher high level 1. So until now we have one higher low and one higher high level, but we need at least 2 higher highs and 2 higher lows to confirm the uptrend. So let's just wait and see if price goes up or down. So as you can see, price finally rose up and made a new high above the previous high. So is this the new high or higher high level 2? Well, we don't know yet. Price can rise more up, so we need another bottom level to confirm the higher high 2. But we have the confirmation that the previous bottom is higher low 2. So until now we have 2 valid higher lows and 1 valid higher high in this price action chart. And again, if I uncover some more price action, then you can see that price falls from the current high and made a new bottom level as price retraced almost 50% of the previous bullish rally. So we can call the current high as higher high too. So until now, we have two higher highs and two higher lows in this price action chart. So finally, the uptrend is now confirmed, though we can't say for sure if the uptrend will continue for more time, but still it's an uptrend formation on this price action chart. So now we can place long trade entries at every next higher low point we will see in this uptrend. Now let's see if we got a strong bullish candlestick pattern after the big bearish candle, so that we can be sure about the validity of this current bottom level and hence can trigger long trade entries on this new uptrend market. And if we wait for the next candle to form, then you can see that we got this bullish candle inside the big bearish candle at the bottom. So this is a bullish inside bar candlestick pattern at the bottom of an uptrend. Now, since we have confirmed the uptrend and we got a bullish candlestick at the bottom, we can trigger long trade entry right after the closing of the bullish candle if we want to go aggressive here. But we should not do that, rather we need to wait for the inside bar pattern to get broken from the top, because price can go furthermore down after this bullish inside bar candle. So it would be a wise decision to wait for the exact confirmation to trade long. So we will wait for the mother candle's high to be broken, only then we can trigger our very first long trade entry on this new uptrend. So let's wait and see in which direction price break the mother candle's range. And as we had expected, the inside bar candlestick pattern worked as a trend reversal pattern and hence price broke the mother candle's high. Now we can trigger long trade entry after the breaking of the mother candle's high. And since the mother candle is quite big, so our stop loss should be around 80% below the mother candle's range. And our profit target should be set for at least twice the size of the stop loss using 1:2 risk and reward ratio model. So now let's wait and see if our very first trade on this newborn uptrend can give us some profit or not. And as I uncovered some more price action, then you can see that our profit target got hit and we booked more than 150 pips in this one single trade from this newborn uptrend. Now it looks like an uptrend if you want to notice the price action with bare eyes without counting the higher highs and higher lows. But by the time other price action traders who depends on the indicators only to detect a trend, preparing themselves for the next higher low to go long, we already booked some early profits from this newborn uptrend without risking too much of our capital. Isn't it too much simple? You can see how comfortably we booked a large number of pips by following some simple rules. And this is not the end yet. Now let's see if we can catch more profit from this newborn uptrend. And as I uncover some more price action, you can see that price went down for at least 40% of the retracement from the previous rally and hence qualified to make a valid bottom. Now let's see if any strong bullish candlestick pattern will form after these bearish candles so that we can place another long trade entry on this uptrend market. Now if we wait for the next candle to form, then you can see that a strong bullish engulfing candlestick pattern has appeared at the bottom of this uptrend, which indicates that the uptrend will continue for more time after this engulfing candlestick pattern. Now that we have all the three confirmation here, like we are in an uptrend, we have a valid higher low level and a strong candlestick pattern, so that means we have a valid signal to go long. So let's trigger long trade entry at the closing price of the engulfing candle, then set the stop loss at 3 pips below the engulfing candlestick pattern, and then aim for the initial profit target for at least 2 times the size of the stop loss. Now that we are all set, so forget everything about the trade, take a break from the trading desk, enjoy the time with your friends and family, do whatever you want to do, and just get relaxed. And let's say after you enjoyed the time on your own way, you sat in front of your trading desk with a cup of coffee to see if your profit target got hit or not, then you will notice that the price has hit the profit target for even this trade too. Isn't it a very simple and an effective strategy to trade in an uptrend market? Yes, it is, right. So that's how we will trade the uptrend even from the very beginning of its birth. This is a very simple and effective way to trade the market by analyzing the price action chart. Every single step that I mention here in this video is a tested method by the market professionals. So practice this strategy by analyzing the old price action chart and make yourself more comfortable to trade the market and become a successful swing trader. In the next lecture, I will show you the strategy for short trade entries in a downtrend market. So that's all for now. We'll see you in the next lecture. Till then, goodbye and have a nice day. Hello traders, welcome back. In the previous two lectures, we have learned about how to detect an uptrend when it just started to form, and then the method to trade long on that uptrend using swing trading strategy. Now in this lecture today, I will show you how to detect a downtrend from the very beginning of its formation and the method to trade this downtrend using swing trading strategy. As you already know that price falls in a downtrend market, making continuous lower highs and lower lows. These lower highs and lower low levels or the swing points gives the best trading opportunity to a swing trader to trade the market. And as a swing trader, you should never trigger a long trade entry in a downtrend market unless you become a master in swing trading and have a good amount of knowledge on trade managing using multiple time frames. As a swing trader, you are only allowed to trade short in a downtrend market. So we will only look up for short trade entries on a downtrend market. I will tell you more in a later lecture about why we should avoid trade long in a downtrend market and why we should avoid to trade short in an uptrend market. Now, how to detect a downtrend momentum on the market when it just started to form? Because at the beginning of a trend formation, it is very confusing to predict its ultimate direction. Well, this is very easy, and if you have watched the previous two lectures, then you can guess how to do that. So the trick is, we need at least 2 lower highs and 2 lower lows to have a confirmation of a downtrend market. And the next question is, from which point we should start counting the lower highs and lower lows? It is very simple. Always remember that the highest peak point or top level from which price started to fall is our lower high 1. Then the first bottom level from the lower high 1 will be considered as lower low level 1. And then the second top level after the lower low level 1 is the lower high level 2. Now, to confirm a downtrend, we just need another lower low to form on the price action chart. And finally, if price continues to fall and make a new bottom below the previous bottom level, then this new bottom level is our lower low level 2. Now that we have 2 lower highs and 2 lower lows in a price action chart, that indicates that the downtrend has now begun. Although we have the confirmation of the downtrend momentum, but still we don't know for sure if the downtrend will continue for a long time. But if you have at least 2 back-to-back lower highs and lower lows in a price action chart, then that means you are watching a downtrend market. But remember one thing very carefully, that we can just predict the market momentum based on the previous market history. That means we can never be 100% sure of the next price movements. We can only just predict the direction of the market. So never raise your trade volume in a single trade, no matter how strong the signal is. Always be disciplined to the proper money management system. Now that we have all the confirmation of the downtrend momentum on a price action chart, to trigger short trade entry, we just need a strong bearish candlestick pattern at the lower high level to indicate the final short trade signal. That is all we need to trade short in a downtrend market. So now we can start triggering short trade entries from the third lower high level to every next lower high levels the market will create on this downtrend market. That's the simplest and effective way to trade the short trades in a downtrend market. You will learn more things to validate a trade entry, but these are the main steps to trade the swings in a downtrend market. So I am signing off for today. In the next lecture, I will show you how to detect the downtrend momentum on a price action chart and hence trade short entries using swing trading strategy with real chart examples. So until then, have a nice day and goodbye. Hello traders, welcome back. In the previous lecture, I have discussed about how to detect and trade a downtrend market when a downtrend is just started to form. The previous video was a graphical demonstration of the method, and in this lecture today, I will show you the method with real chart examples. So let's start. As you can see, this is a day chart of New Zealand dollar versus Canadian dollar, where you can see that the market is trending at the upward direction at the moment on this chart. And as you can see, the bearish pin bars high is the current market high of the time on this price action chart. Now, if price goes down and form a downtrend momentum by making continuous lower highs and lower lows, then the pin bars high will be our first lower high level. So let's wait and see in which direction the market ultimately goes. And as I uncover some more price action on this chart, you can see that price falls for more than 350 pips in the next few days. And you will also notice that a bullish candle has appeared at this bottom, where the candle's lowest price is the current market low and the candle's lower shadow indicates bearish rejection, which predicts that the market will rise again towards the upward direction after this bullish candle. That's why if price goes up after this bullish candle, then we can tell that the low of this bullish candle is the new bottom. And if a new downtrend momentum forms on this chart, then we can name the highest price level of this price action chart as lower high level 1, as well as the current bottom level as lower low level 1. Now let's see if price goes towards the upward direction and make another top level by staying below the previous top, so that we can name the new top as lower high level 2. Now if I uncover some more price action, then you can see that price rose up but could not break the previous top level. You will also notice a strong bearish engulfing candle at the top with an upper shadow, which indicates the rejection of bullish momentum and hence predicts that the bullish rally towards the upward direction is now over and the market is going to fall again. So the highest point of the engulfing candle is a very top level if price falls after the engulfing candle. And because the top has formed below the previous top level, we can call this top as lower high level 2. So until now we have 2 lower highs and 1 lower low level. We only need another lower low level to confirm the downtrend momentum of this market. Now if you trade short after this bearish engulfing candle, then it would be a risky trade entry since we are still not confirmed if the market will go more down and the uptrend will end it up. Chances are huge that price will get a pullback towards the upward direction and hence the uptrend will continue. If that happens, then your short trade will hit the stop loss. That's why we should not trigger short trade entries before we have the confirmation of the end of the uptrend momentum and as well as the beginning of the downtrend momentum. So let's just wait and stick to the rules. Now let's see if price falls at the downward direction and make a new bottom by breaking the current bottom level, so that we can name the bottom level as lower low level 2. And if I again uncover some more price action, then you can see that price falls down and broke the previous bottom level. You will also notice that a strong bullish candle has appeared after the bearish rally, which indicates that the bearish momentum is getting weaker and the bullish momentum is getting stronger. It also indicates that the bullish candle's low is the new bottom level and price will rise after this bullish candle to make a new top level, which we will call as lower high level 3. So if price rise up and create a new top below the previous top level, then we can name this bottom level as lower low 2. And if that happen, then that means we have 2 valid lower highs and 2 valid lower lows in this price action chart. So we can now assume that the downtrend is now confirmed. Now we will search a strong bearish candle at the upcoming lower high point to trigger short trade entry. So let's wait for the next lower high to form so that we can trigger our very first short trade entry on this newborn downtrend market. And if I uncover some more price action, then you can see that price rose up and has retraced 50% of the previous rally, where we have a pin bar with a bearish head or a bearish hanging man candlestick pattern at the top. This bearish pin bar or hanging man does not show any strong bearish momentum because the lower shadow or tail of this pin bar indicates that there are still some good amount of buying pressure exists in the market where the buyers fought very well against the sellers. That's why the long lower shadow or tail of the pin bar indicates bearish rejection and the existence of strong buying pressure. So we should not jump into the market right at the moment. Rather, we should just wait for another strong bearish candle to confirm the upcoming strong bearish momentum on this downtrend market. So if we wait for the next few candles to form, then you can see that another bearish pin bar or hanging man candle has appeared right after the previous bearish pin bar. So still we can see some bearish rejection through the long lower shadow of the current bearish pin bar. That's why we should not trigger any short trade entry right now, since there's a good amount of bullish momentum still exists in the market. Nor we should trigger long trade entry because we don't buy in a downtrend market. So let's just wait until we have a strong bearish candle which will offer us to take short trade entries. Now if I uncover some more price action, then you can see that 2 back-to-back strong bullish candle has formed after the bearish pin bars. So if we traded short at the previous pin bars, then our stop loss would have got hit. So price has retraced almost 80% of the previous rally. At this stage, we need a strong bearish candle if we want to see the newborn downtrend to sustain for more time. Because if price continues to rise up and break the previous high, then chances are huge that the previous uptrend will resume again and hence our newborn downtrend will end up without giving the opportunity to trade short. But we got no hand on the fate of the market. So let's just wait again until we see a strong bearish candle to form below the previous lower high level, so that we can place our first short trade entry on this newborn downtrend market. And if we wait for another candle to form, Then you can see that finally we got a big bearish engulfing candlestick pattern below the previous lower high level, which has engulfed even the previous two bullish candles. So now there are no confusion about the strong bearish momentum on the market after this bearish engulfing candlestick pattern. So the top of the engulfing candle is the lower high level 3. And as I told you before that the third lower high level is the first trading point of a downtrend market. So let's trigger our first short trade entry at the closing price of the bearish engulfing candle, then set the stop loss around 20% below the high of the engulfing candle since it's a big candle to trade, and then set the initial profit target for at least twice the size of the stop loss. So now that we are all set, it's time to get relaxed and wait for the profit target to get hit. So let's wait and see if we have won the trade or not. And as I uncover some more price action, you can see that our targeted profit level got hit. So we had confirmed a downtrend momentum and then triggered short trade entry at the very first short trade opportunity on that downtrend and finally won the trade. And all that has happened using the most reliable swing trading strategy. It's very simple and easy to detect and trade the trends if we maintain all the rules of swing trading strategy. Now, if I uncover the rest of the price actions of this chart, then you can see how nicely the market has moved on its trend direction. You could have get the chance to enter in this downtrend market for several times. Even if someone missed the first trade opportunity, he or she can get it from the second one. So there are always so many valid swing trade opportunities in the market if you can spot those as a swing trader. Although this is an almost perfect trading method to trade the trends, but there are still lots of other things that you have to learn in order to filter the invalid trade setups and hence reducing the losses and maximizing the profits using swing trading strategy. Until now in this section, you have learned the basics of swing trading strategy where we traded the market by just analyzing the price actions. We did not use any indicators or other tools for extra level of confirmation of the trades. So from the next lecture until the end of this section, you will learn some more advanced techniques which we will integrate with our swing trading strategy so that you will have more accuracy in your trades and get maximum profit from every single trade that you will make using swing trading strategy. So that's all for today. We'll see you in the next lecture. Till then, have a nice day and goodbye. Hello traders, welcome back. In the previous lectures of this section, I have explained you every main steps and rule of swing trading strategy where I did not use any indicators or tools to place a trade entry. The method of all the trade entry positions was based on pure price action on the chart, because I believe that if you can analyze the market data using just the pure price action on a price action chart, then you can enhance the analyzing method with any other tools or indicators which can act as an extra level of trade confirmation instrument on your trading strategy. And now, from this lecture on to the next few lectures, I will show you more advanced method to trade the swings of a trend. But you don't need to worry. I will not use any nasty looking indicators which will distract you to understand the market sentiment instead of helping you to validate a trade on a trendy market. So in this lecture today, I will tell you about one of my most favorite indicator that helps me to have an extra level of trade confirmation whenever I want to trigger a trade in a trendy market. So let's start. As you can see, this is a forward chart of US dollar versus Japan yen, and you will also notice that the market is trending upward on this price action chart, and the uptrend has established by making continuous higher highs and higher lows where every valid bottom is the higher low point on this trend, which gives the swing traders an excellent opportunity to trade long in every valid higher low point they see in this uptrend market. Although we can trade this uptrend with our swing trading strategy as you learned in the earlier lectures where we traded the trend by following 3 main steps to analyze the market. Wouldn't it be great if we have a more reliable and an extra trade confirmation setup with the help of an indicator? Well, I think it would be nice if we integrate and have one more trade confirmation setup in our strategy. So look at the same chart again, but now you will notice that there are 2 special moving average indicators have been set on this price action chart. Look at the chart very carefully, that how nicely price gets rejection to go more down below these moving average lines, while the market was having a retracement towards the downward direction. All the higher low points as well as the strong bullish candlesticks at those higher low points has been formed right above the moving average lines. Price always respected these moving average lines as if these 2 moving averages are acting like a trend line support for the price actions in this uptrend market. These moving averages always acts as a dynamic support and resistance level in our price action chart, but especially in a trendy market, whether it's an uptrend market or a downtrend market. So every high-low levels which has formed above the moving average lines gives you an extra level of comfort and signal to trade long. Now let me show you how to set up these moving averages on your chart using MetaTrader trading software. I use two exponential moving average indicator on my chart. One is the 30 exponential moving average and the other one is the 50 exponential moving average. To set this moving average indicator in your MetaTrader trading software, at first open up the terminal with a price action chart. Then take a look at the upper left window of your trading terminal. Here you will see a tab named Insert. So click on it. A new section will be toggled down. From here, go to the indicator, then go to trend, and from here, click and select the moving average. Then a new window will be opened. Here you will see some custom fields to set the values of moving average, where we will only modify the parameters for our moving average setup. So for our first moving average, type 30 in the field named period. Then click and select exponential from MA method field. And then on the next field, click and choose the close value to apply. After that, select and choose any color for the moving average line. In my chart, I use orange-red color for 30 exponential moving average. So I select orange-red for my 30 exponential moving average, and if you did the same things along with me, then click the OK button to finish the setup. After you hit the OK button, your chart will look something like this. This single moving average line is enough for most of the trade signals, but we will set another one to have a better trade confirmation. Now repeat the same procedure to set the next moving average value. Click on the Insert tab, then go to Indicators, then go to Trend, and then click Moving Average. Here, apply all the settings as the previous one, which we did for the 30 exponential moving average. The only thing we will change here is the color and the period value. Set the period value to 50 and give it a color. In my case, I use light blue color for the 30 exponential moving average. Now that we're all done, just hit the OK button to finish the setup. And that is all. We're all done to set these two special moving average, which we are going to use in our price action chart to have an extra level of trade entry confirmation along with swing trading strategy. Now that you have learned about how to set these moving averages in your chart, it's time to know how to make a proper use of these moving averages in a trendy market. But I will tell you that in the next lecture. So we'll see you in the next lecture. Until then, have a nice day and goodbye. Welcome back traders, what's going on? In the previous lecture, I have discussed about two special moving averages that we will use to have an extra trade confirmation in our price action chart. And in this lecture today, I will show you how to confirm an uptrend market using swing trading strategy and then the method to trade the uptrend using those two special moving averages along with the swing trading strategy. So let's start. As you can see, this is a day chart of pound versus yen, where we have two moving averages as our only indicators in this price action chart. And you will also notice that the market is trending in the downward direction on this price action chart at the moment. The most recent candle on this price action chart is a bullish candle where the candle has formed after a pin bar candlestick pattern at the bottom, which indicates that the bullish momentum is getting stronger over the sellers. So chances are huge that price will rise again after this bullish candle. Either price will rise to have a retracement or to create a new lower high level of the current downtrend, or the price will rise to form a new uptrend. Whatever happens, we don't need to worry all that about. Just wait for the exact signal to in or out of the market. Now let's say from this stage, if the market rises up and create an uptrend formation by making continuous higher highs and higher lows, then this bottom level, which is the current lowest price of the market, would be the first higher low point of the upcoming uptrend on this price action chart based on swing trading strategy. So let's just wait and see what happens next. And as I uncover some more price action, then you can see that price rose up and even breaks the previous top, which is a small indication for the bearish traders that the downtrend momentum is maybe going to have an end. But still, the downtrend momentum remains strong, as you can see a strong bearish candle has formed at the lower high point of the current downtrend market. So there are so much possibility that the price will go down after this bearish candle at the top, and hence the downtrend will continue its journey towards the downward direction. So we will consider this current top as a lower high level of this downtrend market. But if the price goes down and then without breaking the previous bottom, price rise up and break the previous top, then the current top will be considered as higher high level 1 in terms of uptrend formation using swing trading strategy. Now let's see on which direction the price ultimately goes. And as I uncover some more price action, then you can see that price went down but could not break the previous bottom to continue the current downtrend momentum. You will also notice that a pin bar has formed and even a bullish candlestick has also appeared after the pin bar, where the bullish candle has closed above both the moving average lines, which indicates that the selling pressure is so weak to bring the price more down to continue the downtrend momentum, which means the buyers are getting stronger over the sellers. So possibilities are more that the price will continue to rise up after this bullish candle. And if that happens, then we can call the current bottom level as higher low level 2. Now if we traded short at the previous bearish candle, since it was a signal to trade short as we were in a lower high level of a downtrend market, then we may consider to close the trade right now by the time we see the spin bar and a bullish candlestick pattern at the bottom, since it seems like the downtrend is going to have an end. That's how sometimes we can close a trade when it seems like the trend will change its direction, so that we can reduce the loss size if the trend really changes its direction. But because we have not confirmed the uptrend yet, so we should not trigger any long trade entry here after the bullish candle. So let's wait and see if the price goes up from this bottom level and make a new top level so that we can name the top as higher high 2 and have the final confirmation of the new uptrend. And if I again uncover some more price action, then you can see that price rose up by breaking the previous top, and you will also notice that a bearish pin bar or hanging man candle has appeared at the top. So we can assume that price will fall down after this pin bar at this swing high level. And if that happens, then we can name the current top or swing high as higher high level 2. So until now we have 2 higher highs and 2 higher lows in this price action chart, which means technically the uptrend is now confirmed. So now we will wait for another retracement or next higher low to form so that we can trigger our very first long trade entry on this newborn uptrend. So let's wait and see what the market brings us next. And as I uncover some more price action, then you can see that price went down for a retracement after that bearish pin bar at the top. You will also notice that a strong bullish pin bar candlestick pattern has appeared after the bearish rally at the retracement level. The long tail of the pin bar below the moving average lines shows very strong bearish rejection, and even this bullish pin bar gets closed by staying above both the moving average lines. So these moving averages has worked as dynamic support here at this retracement level. This is an indication that we are in a valid higher low level on this new uptrend. So now that we have an uptrend confirmation, a valid higher low level on that uptrend, a strong bullish candlestick pattern at the higher low level, and an extra confirmation with the 2 special moving average where these moving average lines preventing price to go more down, what else do we need to trigger long trade entry? Well, you can use 100 more indicators, but they will only confuse you instead of giving you the understanding of market psychology and exact trade signal. This combination is the most accurate and highly probable price action setup to trigger long trade entry. So now you can confidently trigger long trade entry at the pin bar's closing using the standard pin bar trading method, and then wait for a good amount of profit to earn from this newborn uptrend market. And again, remember one thing very carefully, that never raise your trade volume and do not take risk more than 3% of your total trading capital. And never forget to set the stop loss, because the market can change its momentum at any time without any sort of alert. So always be disciplined to the proper money management system along with the trading strategy. Now if I uncover the rest of the price actions of this chart, then you can see that how nicely this uptrend has continued its journey towards the upward direction by making continuous higher highs and higher lows. And notice how every higher low level as well as the strong bullish candlesticks has formed right above the moving average lines. These moving average lines worked as dynamic trend line and as well as dynamic support in this price action chart. In an uptrend market, price always tends to get rejected to go more down below these moving average lines. So if a strong bullish candlestick pattern gets closed by staying above the moving average lines at the higher low level of an uptrend market, then it is the best signal to trade long. Practice this setup using old price action chart. Without practicing any strategy by your own, you won't be able to use that strategy to make consistent profit. So that's all for today. Hope you guys enjoyed the lecture. In the next video, I will give you examples of trading on a downtrend market using these moving average lines along with the basic swing trading strategy. So we'll see you in the next lecture. Till then, have a nice day and goodbye. Welcome back, traders. In the previous lecture, you have learned about the advanced entry method of swing trading strategy where we traded an uptrend market. And in this lecture today, I will show you the method to trade the swings in a downtrend market using those two special moving averages along with swing trading strategy. So let's start. As you can see, this is a 4-hour chart of pound versus US dollar, and the market is trending towards the upward direction, which you can see even with the moving average lines where the moving averages are also indicating the upward momentum. So as long as these moving averages stays below the chart price action, we can say that the market is still being running on a bullish momentum. Now as you can see, the top of this bullish candle is the current market high on this price action chart. Now from this stage, if a downtrend momentum forms by continuously making the lower highs and lower lows, then the current top on this chart will be considered as lower high level 1. So let's wait and see if the downtrend forms and then the moving averages changes their direction along with the price actions in this chart. And as I uncover some more price action, then you can see that price rise up for few more pips by riding with small and unhealthy bullish candles. And after then, a strong bearish candle has appeared and engulfed the total retracement. So if the price falls down after the bearish candle, then that means the top of the retracement is an invalid top, because the retracement has been made by 4 very small and unhealthy bullish candles later on, which has been engulfed by the next bearish candle alone. That's why we can't consider the top as valid lower high or even higher high at any point. So let's just wait for more time to have a valid swing point. Now if I uncover some more price action, then you can see that price falls for more pips and break the previous bottom or higher low level on the current uptrend, and the bearish candle has closed below both of the moving average lines. And even both the moving averages has started to lower their position from upward to downward direction on this chart. So until now, you can see that price falls down and broke the previous bottom or higher low of the uptrend and as well as the moving average. So that's a sign that the uptrend may be going to have an end, since price could not make a new higher low level by staying above the previous higher low level, which is required to remain as an uptrend. Because as you know that every higher high must form above the previous higher high and every higher low must form above the previous higher low for the validity of an uptrend. Now if price rise up and then create a valid top by staying below the previous higher low level of the current uptrend, where we will find a strong bearish candle, then we can name this current bottom level as lower low level 1 and then the next peak as lower high level 2 by assuming that the downtrend is confirmed. So let's just wait for more time to see what will happen next. And as I uncover some more price action, then you can see that price rose up to a significant level to make a valid top. And if we can find a strong bearish candle at that top, then we can name this new top as lower high level 2. But for that, we need to have a strong bearish candle at this top level. And if we find a strong bearish candle at this top, then we can confirm that the downtrend has begun. We don't need to wait for the third lower high level in this case to trigger short trade entry, because a strong bearish candle at this top level means that price will fall after the bearish candle, which is why the price will not rise to break the previous top or higher high level of the current uptrend. So that would mean that the uptrend has failed to create a higher low level as well as a higher high level in this price action chart, since the current bottom has formed below the previous bottom and the current top has also formed below the previous top level. So that's the sign of the end of the uptrend momentum and the beginning of the downtrend momentum. But the main thing is we need a strong bearish candle at the top to confirm the downtrend, because from this stage price can rise up and break the higher high level and resume the uptrend again. So let's just wait for more time to have a strong bearish candle at this top level to confirm the downtrend. And as I uncover some more price action, then you can see that a strong bearish candle has appeared at the top, where the candle has closed by staying below the 30 exponential moving average line, which indicates that the buyers are so weak to pull up the price to continue the uptrend, which is why sellers took control of the market and the market is now ready to fall again. So that's the confirmation of the end of the uptrend and as well as the beginning of the new downtrend. So until now, we have 2 lower highs and 1 lower low in this price action chart. We got the downtrend confirmation on lower high level 2 instead of lower low level 2, since we had a couple of invalid swing points on this chart, which makes a valid swing point. This confirmation method is a part of the strategy for invalid swing points. You will learn that more in the next section. So now that we have the confirmation of a downtrend market, and a strong bearish candle at the lower high level. So let's trigger short trade entry at the closing price of the bearish candle, which has closed by staying below the 30 exponential moving average line. And then set the stop loss at 3 pips above the high of the lower high level, and then set the profit target for at least 2 times the size of the stop loss. And as I uncover some more price action, then you can see that our profit target got hit as we had expected. There are so many strategies out there where they will teach you to trade at the moving average crossovers without the proper analyzing method of price actions on the chart. But that is wrong if you don't analyze the price actions of the market and depends on the indicators only. Indicators like moving average, stochastics, RSI or almost any other tools always runs behind the price action of the market, which is why almost all the indicators that you will see are called as lagging indicators. So indicators can't be the main factor to trigger a trade. Always look at the price action, try to analyze and read the market sentiment, and then make the trading decision regarding your analysis. Take help from the indicators only if you need to have an extra level of confirmation besides the price action. Look at this chart again. By the time the two moving average lines on this chart overlapped each other, the market already made its move. So by the time the traders who trade the moving average crossovers only, waiting for the next lower high level to trigger their first short trade entry on this newly formed downtrend market, we already entered in the market and booked a large number of profit by analyzing the price action of the market along with the moving average. So if you had waited for the moving averages to overlap each other and then trade short without analyzing the price action, then you could have missed the earlier trade opportunity here. So if you follow and trade the price actions using swing trading strategy, then there are more possibility that you will never miss a very trade opportunity in any trendy market. Now, if I uncover the rest of the price actions of this chart, then you will notice that we had so many short trade opportunities in this downtrend where all the lower high points has been formed below the moving average lines, which gives us the extra level of confirmation to place short trade entries. These moving average lines always work as dynamic resistance here in this downtrend market. You can use this moving average setup along with swing trading strategy to have an extra level of trade confirmation on a price action chart. So practice this setup using previous market data and make yourself an expert in swing trading so that you can earn consistent profit from the market. So that's all for today. We'll see you in the next lecture. Until then, have a nice day and goodbye. Welcome back traders, what's going on? In the previous 3 lectures, you have learned about the advanced entry method using moving averages along with the basic swing trading strategy. Now from this lecture on to the next few lectures, I will show you some more trade advancing method which can help you to validate a trade in a trendy market. So the method we are going to talk about in this lecture is having trade confirmation on support and resistance level on a price action chart using swing trading strategy. In the second section of this course, I have explained you about the basic concept of support and resistance levels along with their importance and widely usage in price action charts. If you trade the market analyzing the price actions only, then you must be aware of the impacts of support and resistance levels no matter which strategy you follow. So let's start knowing about how we can trade the trends using swing trading strategy and have an extra level of trade confirmation signal from the support and resistance levels. As you already know that every swing point, either it's a swing high or swing low, it can be a support or resistance on a price action chart depending on its relative position in the market. A resistance will resist price to go further up and a support will prevent price to go further down. A resistance will be turned into a support level by the time price will go up by breaking the resistance level. On the same way, a support will be turned into a resistance level by the time price will break that support level. That means in an uptrend market, when price falls down to have a retracement and then comes near to a previous support zone, that time sellers tend to close their trades and buyers tend to enter the market, which is why selling pressure becomes weaker and buying pressure becomes stronger at that support level. And for that reason, you will usually see strong bullish candlesticks to appear at that support level. So whenever a strong bullish candlestick pattern appears at the support level as well as at the higher low level in an uptrend market, then this price action setup indicates very strong bullish momentum on the market and signals to trade long, since the market tends to move in the direction of the bullish candle after the candle appears at the support level in an uptrend market. Now let me show you these types of trade setup using real chart example. As you can see, this is a day chart of silver versus US dollar, and you will notice that the market is trending upward on this chart. Now, as you can see, the most recent bottom is a support on this chart since price could not break the trend to go more down, and a top which we can consider as a resistance level which prevented the price from going more up for a certain period of time. But when after price break the resistance level and then created a new top level, then that previous resistance has now become our new support level on this price action chart. Now, if the price falls down to have a retracement, then possibilities are more that price will get rejected to go more down below this new support level, since a support is a psychological range where sellers tend to close their trades, which gives the buyers the opportunity to enter the market. So there is a good chance that you will see a strong bullish candlestick pattern at this support level on this uptrend market. And after that candle, price will rise to make another bullish rally towards the uptrend direction. So let's wait and see what the market brings us next. And as I uncover some more price action, then you can see that price went down towards the support level and even price broke the moving average lines, where these moving averages are working as dynamic support. Though there is no sign of bullish momentum on the market yet, but the most recent bearish candles in this rally are very weak so that they do not show any kind of strong bearish momentum either. Now, if we find a strong bullish candlestick pattern at this support range, then that would mean that the sellers are closing their trades while buyers started to enter in the market right after price reached the support zone, which is why chances are huge that price will rise again towards the upward direction and hence the uptrend will continue its journey. So let's just wait again and see if we really have a strong bullish candlestick pattern at this support level. And as I uncover some more price action, then you can see that a strong bullish candlestick has appeared at this support level, and even the candle got back and closed by staying above the 50 exponential moving average line. So it's an indication that the buyers came back strongly over the sellers, and hence the market is ready to climb again to continue the uptrend journey. So this bottom at the support level on this uptrend is a new higher low level. And as you know that the higher low levels are the trading points where we trade long according to swing trading strategy. And since we have a strong bullish candle at this higher low level, so we can now trigger a long trade at the closing price of this bullish candle. So this time we triggered our long trade by having at least 5 trade confirmation signals, which means we traded long at the higher low level in an uptrend market where the higher low has been validated by a strong bullish candle at the support level, and even the candle has closed by staying above the 50 exponential moving average line. So this price action setup indicates only one thing, and that is the upcoming bullish momentum on the market. So possibilities are very high that we are going to win this trade. Now, if I uncover the rest of the price action of this chart, then you can see that price continued to rise up for more than 30 trading days after we triggered the long trade at the support level. So that's how we can trade an uptrend market whenever price will get a pullback after it reaches the support level. Remember one thing very carefully, that to trigger long trade entry in an uptrend market, the higher low levels of that uptrend does not need to form in a support level. As long as you find a strong bullish candlestick pattern at the higher low level in an uptrend market, then this price action setup is well enough to trigger long trade entry. Price above the moving average lines and a strong bullish candlestick pattern at a support level only strengthen the validity of the trade. So many times you will see the long trade opportunity in an uptrend market, but you will find no strong support zone near the trading point. So higher low levels are not essential to form in the support levels to trade in an uptrend market. As long as you have the confirmation of a trade using 3 of the main steps of swing trading strategy, you are allowed to trigger your long trade entry as a swing trader. So that's all for today. We'll see you in the next lecture. Till then, have a nice day and goodbye. Hello traders, welcome back. In the previous lecture, I have shown you how to trade an uptrend market whenever a trading point forms at the support zone on a price action chart. And in this lecture today, I will be talking to you about the trading method at the resistance zone in a downtrend market using swing trading strategy. So let's start. As you already know that a varied bottom or swing low point acts as a support for the upcoming price actions and prevents price to go further down by breaking the support zone. But if price breaks the support and go further down to create another swing low point, then the previous support becomes a new resistance for the upcoming market price actions and prevents price to go further up by breaking the new resistance of the market. So if a strong bearish candlestick pattern forms at the lower high level as well as at the resistance on a downtrend market, then these types of price action setup indicates very strong bearish momentum of the market and hence signals to trade short. Now let me show you these types of trade setup using real chart examples. As you can see, this is a day chart of US dollar versus Swiss franc, and you will notice that the market is trending downward on this price action chart. Now here, this lower high level is the most recent support on this chart. You can see that for the second time when the price falls to this support level, it could not break the range and hence held there for more than 2 trading weeks. There was market indecision between the bulls and bears for a pretty long time. But after 2 weeks of the market indecision at this support level, finally bears came up with strong selling pressure and hence the support level completely gets broken, which is why we got another lower low level on this downtrend market, which is also a new support level if price goes up from this position of the market. So the previous support has now turned into a resistance for the upcoming price action of the market. So possibilities are high that price will get rejected to go more up by the new resistance level, and most probably we will have a strong bearish candlestick pattern at the resistance area by which we can confirm the lower high of the market and hence can trigger short trade entry after that bearish candle and book some profits from the market. So let's just wait and see what the market brings us next. Now as I uncover some more price action, then you can see that price rises up to have a retracement on this downtrend market. You will also notice that a pin bar with an upper shadow or tail has appeared at the top. The pin bar's tail indicates bullish rejection and as well as bearish pressure at the resistance area. Both the moving average lines are also preventing price to go more up. Although we have a pin bar at the top of a downtrend market, still we should not trigger short trade entry at this position of the market, because the head or real body of the pin bar is bullish, which is why we should wait for a bearish candle to form so that we can confirm the upcoming bearish rally of this downtrend market. So let's just wait for more time to see if we can find a strong bearish candle at this most probable lower high level. Now as I uncover some more price action, then you can see that a strong bearish candle has appeared at this resistance area and even the candle has closed by staying below the moving average lines. So in summary, we have a strong bearish candle after a pin bar at the top of a downtrend market where the bearish candle has formed at the resistance area and below the 30 and 50 exponential moving average lines, which indicates nothing but very strong bearish momentum on this downtrend market. So now we can trigger short trade entry at the closing price of the bearish candle by hoping that the market will fall after this bearish candle and break the current lower low level or the latest support level of this market to create another lower low level so that we can grab some easy pips from this downtrend market. Now if I uncover some more price action, then you can see that price went down for a massive distance by breaking the previous lower low or support level and has created another lower low level on this downtrend market. Now because price went down by breaking the previous support level, which means that previous support has now turned into a resistance level on this price action chart. So chances are huge that price will rise up to take a retracement until this new resistance level, and after then price will fall again to continue the downtrend journey. So let's just wait again to see what actually happens with this downtrend market. And as I uncover some more price action, then you can see that price rises up and created a new lower high level, but price could not break that resistance. Rather, we have a strong bearish candle at that resistance level, and even the bearish candle has closed by staying below the moving average lines. So again, this whole price action setup indicates very strong bearish momentum as like the previous trade setup on this downtrend market. So let's trigger another short trade entry at the closing price of this bearish candle by hoping that price will fall again and give us some more profit from this downtrend market. Now, if I uncover the rest of the price actions of this chart, then you can see that price falls down after we traded short at the resistance level on this downtrend market. So that's how we can have an extra level of trade confirmation signal at the resistance of a downtrend market using swing trading strategy. Again, remember that the lower high levels does not need to form at the resistance of a downtrend market in order to trade short. As long as we can confirm the trade setup using 3 main steps of swing trading strategy, we are all enough to trigger short trade entry at the trading point of a downtrend market. Moving averages or support and resistance levels are the extra tools and setup to validate a trade. These are not essentials. So practice these setups using old price action charts and make yourself more experienced to trade the market as a swing trader. So that's all for today. Hope you guys enjoyed the lecture. We'll see you in the next lecture. Till then, have a nice day and goodbye. Hello traders, welcome back. In the previous lectures, you have learned about advancing the trade entry positions using moving average, support and resistance levels along with the basics of swing trading strategy. Now from this lecture on to the next couple of lectures, you will learn another method of advancing the trade entry setup using swing trading strategy. So the tool or method we are going to integrate with the basic swing trading strategy is called the Fibonacci retracement tool. Fibonacci retracement tool is very popular to the price action traders since this tool helps very much to identify the most probable retracement levels in a price action chart. Before I explain you the method of the usage of Fibonacci retracement tool, let me first tell you about some of the basic details of Fibonacci retracement levels, which includes a short details of the Fibonacci number series and the important Fibonacci ratios, then the very basic understanding of the Fibonacci levels as their usage and importance on a price action chart, then the calculation method of Fibonacci ratios from the Fibonacci numbers, and then the manual calculation method of the Fibonacci retracement levels on a price action chart using those Fibonacci ratios. So these are very important things to understand since we are going to use Fibonacci levels to identify the most probable retracement levels as well as the Fibonacci expansion levels, so that you will understand clearly that how the Fibonacci levels being calculated and works in a price action chart. So what is Fibonacci, or from where the term Fibonacci came from? Fibonacci is the name of a famous Italian mathematician who had introduced the Fibonacci number sequence to the Western Europe. In mathematics, Fibonacci numbers are the sequence of the integer numbers in which sequence after the first two numbers, each and every number is the sum of its preceding two numbers. This sequence is known as Fibonacci sequence. For example, if we sum the fourth and fifth number of the sequence, which are 3 and 5, then we will have the sixth number of the sequence, which is 8. On the same way, if we sum the fifth and sixth number from the sequence, which is 5 and 8, then we will have the seventh number of the sequence, which is 13, and so on. Now, in technical analysis, these Fibonacci numbers are quite useless unless we use the ratios of Fibonacci numbers, which we can use to identify the Fibonacci retracement levels and Fibonacci expansion levels. So, what are the Fibonacci retracement levels? Fibonacci retracement levels are the mathematical ratios between two of the Fibonacci numbers. Most popular Fibonacci ratios are 23.6, 38.2, 61.8 and 161.8. These ratios are mainly used for identifying the retracement levels of a trend, where these levels acts as a support in an uptrend market and resistance in a downtrend market. Most of the times, trading points of a trend tends to form on these Fibonacci levels. So these are very important levels to consider about. Let's say this is a price action chart in an uptrend market where we have a strong bearish pin bar at the top or higher high point of the uptrend. Now this bearish pin bar indicates that the market is now ready to fall down to have a retracement so that a new higher low level can be formed from where price will rise again to continue the uptrend journey. Now we don't know yet that how far price will fall down, but we can predict that retracement level using Fibonacci ratio numbers. So if we calculate the popular Fibonacci retracement levels for a specific price action using Fibonacci retracement tool in a charting software, then we will have at least these three Fibonacci retracement levels, where these levels will act as a support for the upcoming price action. Now let's say if price goes down, then the 23.6 Fibonacci level will act as a first support and will prevent price to go more down. So if you see any strong bullish candlestick pattern at the 23.6 Fibonacci level, then chances are huge that price will retrace back and hence will rise again towards the original trend direction. But let's say if price break the first Fibonacci level and fall more down, then the 38.2 Fibonacci level will act as the second support and will prevent price to go more down. So many times you might see price to rise after getting rejected by the 38.2 Fibonacci level. But still, if price don't respect the 38.2 Fibonacci level and hence break that level too, then the 61.8 Fibonacci level will act as the third support level on this retracement period, and hence will prevent price to go further down. So possibilities are high that you will see price to get a pullback towards the upward direction from the Fibonacci retracement levels, and hence the uptrend will continue its journey. These are some very impactful psychological levels on a price action chart. In an uptrend market, sellers tend to close their trades in these Fibonacci retracement levels, which gives buyers the opportunity to enter the market more strongly so that the uptrend resumes again. The exact same but opposite setup would be applicable in a downtrend market. Here, the Fibonacci retracement levels will act as the resistance for this downtrend market. If price breaks the first Fibonacci level, then the second Fibonacci level will prevent price to go further up. And if price breaks the second Fibonacci level, then the third Fibonacci level will act as the next resistance and hence will resist price to go more up by breaking the Fibonacci level. So these are the levels from where price tends to take U-turn and move towards the original trend direction. Now that you got the basic idea about Fibonacci retracement levels, let me now explain you how does the Fibonacci ratios being calculated using the Fibonacci numbers. It's very easy to do that. After you have the Fibonacci numbers, take any of the number from the sequence other than 1 and 2 and then divide the number by its preceding number from the sequence. If you do that, then the result of the quotients will be 1.618 or near 1.618. This 1.618 number is widely recognized as the golden ratio number. It's also known as divine proportion. You will find this ratio in so many things in the nature. You can search about that in the internet and there you will find tons of interesting resource and information about this number. In technical analysis, this number has a great use in determining the profit levels using Fibonacci expansion tool. You will learn more about that in the later lectures, where I will tell you about the advanced profit targeting setup along with the swing trading strategy. Now again, if you take any of the Fibonacci number other than 1 and then divide that number by its next Fibonacci number from the sequence, then the result of the quotients will be 0.618 or near 0.618. This 0.618 or 61.8% Fibonacci ratio is our third Fibonacci retracement level. That means if you divide a Fibonacci number by its next Fibonacci number, then you will have the ratio of 0.618 or 61.8 Fibonacci retracement level. Again, if you take any of the Fibonacci number other than 1 and then divide that number by its second next Fibonacci number, then the result of the quotient's value will be 0.382 or near 0.382 number. This 0.382 ratio number is the 38.2 Fibonacci retracement level, which is the second Fibonacci retracement level. Again, if you take any of the Fibonacci number other than 1 and then divide that number by its third next Fibonacci number, then you will have the result of the quotients as 0.236 or near 0.236 number. This 0.236 ratio number is the 23.6 Fibonacci retracement level. And as I mentioned before, that the 23.6 is the first Fibonacci retracement level. So that's how the Fibonacci ratios are being calculated from the Fibonacci numbers. Now let me give you the basic idea of how these ratios are being placed on a price action chart to have the Fibonacci retracement levels. Let's say this is an uptrend market where the most recent bullish rally has been made by rising up for 600 pips. Now as you can see, the most recent candle at the top is a bearish candle. So chances are huge that price will fall down for the market correction after that candle. Now we don't know how far price will fall down for the retracement, so to predict that retracement level, let's calculate and draw the Fibonacci retracement levels on this chart. So for the first Fibonacci retracement level, which is 23.6, multiply 600 by 23.6 and then divide that by 100. So if we do that, then we will have 141.6 as the quotient value. So that means 23.6 retracement of 600 pips is 141.6 pips. So we draw the 23.6 Fibonacci level at 141.6 pips from the top. By using the same method, we can have the rest of the two Fibonacci retracement levels, where the 38.2 Fibonacci retracement level has been placed at 229.2 pips from the top. And then the third Fibonacci retracement level, which is 61.8, has been placed at 370.8 pips from the top. So that's how the Fibonacci retracement levels are being calculated in a price action chart, where the 23.6 Fibonacci retracement level works as the first support for the retracement. And if price breaks the first level, then the 38.2 Fibonacci level will work as the second support, and if price breaks the 38.2 retracement level too, then the 61.8 Fibonacci retracement level will act as the third support in this market correction period. So these are the levels from where price retraces back to continue going towards the original trend direction. So that's how the Fibonacci retracement levels are being calculated in a price action chart. But you don't need to worry about calculating them manually. We will use the Fibonacci retracement tool on our charting software to draw the Fibonacci retracement levels on our price action chart. So that's all for today. In the next lecture, I will show you how to use the Fibonacci retracement levels to identify the possible retracement levels or trading points on a trend using real chart examples. So we'll see you in the next lecture. Till then, have a nice day and goodbye. Hello traders, welcome back. In the previous lectures, you have learned about the basic concept of Fibonacci retracement levels. Now in this lecture today, I will be talking to you about having trade entry confirmation at the Fibonacci retracement levels using swing trading strategy. So let's start. Let's say this is a price action chart in an uptrend market where at the top or higher high of the uptrend, a bearish candle has appeared after the long bullish rally towards the upward direction. Now this bearish candle indicates that the market is now going to fall as price consolidation of the bullish rally. But we don't know yet how far price will fall down. If we can identify and have the prediction of the most possible retracement levels, then we can mentally prepare ourselves to enter the market more comfortably. That's where we will take the help of Fibonacci retracement tool. So to use the Fibonacci retracement tool, we will select the tool from our charting software and then drag it from the most recent higher low level to the most recent higher high level on the price action chart. And by the time you do that, at least 3 Fibonacci retracement levels will be placed on the chart by default by calculating the distance from the selected higher low to higher high level on the price action chart. Here, these Fibonacci retracement levels will act as Fibonacci support and as well as predicts the possible retracement levels. Now, if price continues to fall down until the 23.6 Fibonacci retracement level and then a strong bullish candle appears at the 23.6 Fibonacci retracement level, then we can place long trade entry at the closing of that bullish candle. This 23.6 Fibonacci retracement level is less strong relative to other two retracement levels. This level is more effective for larger bullish rallies of the uptrend. And again, remember that we need at least 2 healthy bearish candles to form from the top so that we can call this a valid retracement or valid bottom on an uptrend market. Now, if price don't respect the 23.6 Fibonacci retracement level and hence fall more down by breaking that level, then the 38.2 Fibonacci retracement level will act as the second support and hence try to prevent price to go more down. So, if you find a strong bullish candlestick pattern at the 38.2 Fibonacci retracement level, then that would indicate that the retracement period is now over and hence price will rise again towards the original trend direction. So, we can trigger long trade entry after the closing of the bullish candle at the 38.2 or second Fibonacci retracement level. Now, let's say if price continues to fall by breaking even the 38.2 Fibonacci retracement level, then the 61.8 Fibonacci retracement level will act as the next and third support on this price consolidation rally. Most of the times you will see that the market tends to lose sellers at this 61.8 Fibonacci retracement level. So if you find a strong bullish candlestick pattern at the 61.8 Fibonacci retracement level, then you can consider this as the new higher low level of the uptrend, from where price will rise again towards the original trend direction. So you can trigger long trade after the closing of the bullish candle at 61.8 Fibonacci retracement level. Now, if price falls more down by breaking even the 61.8 Fibonacci retracement level than the previous bottom or the higher low level, which is the 100% retracement of the previous rally, will act as the next support and hence prevent price to go more down by breaking that higher low level. And if still price continues to fall more down by breaking the higher low of the uptrend, then that would indicate the increasing weakness of the uptrend, which means the overall momentum of the uptrend is going to have an end in the near future. Now, let me give you an example of the usage of Fibonacci retracement tool in a real price action chart. As I open up a price action chart on the MetaTrader terminal, then you can see that this is a 4-hour chart of pound versus Australian dollar. Here you will notice that the market is in the uptrend momentum on this chart, as you can see that all the market price actions formed above the moving average lines and all the higher lows and higher highs formation shows the validity of the uptrend according to swing trading strategy. Some of the price actions are hidden from the chart and will be displayed sequentially as I explain you the steps further ahead. Now, as you can see, a bearish candle has formed at this top or higher high level, which indicates strong selling pressure at the moment. So there's a good chance that the price is going to fall down from this position of the market. And since we don't trade at the swing highs in an uptrend market, so we should just wait for the next swing low or higher low of this uptrend to trade long. Since we don't know that how far price will fall down to complete its market correction period, So here we can use the Fibonacci retracement tool to identify the most possible retracement levels. So to use the Fibonacci retracement tool, click the Insert tab on the top left corner of MetaTrader terminal. From here, select Fibonacci and then retracement. By the time you do that, you can see that the mouse cursor has been transformed from an arrow to a plus sign with horizontal lines. That means the Fibonacci retracement tool is now ready to be used. So click and drag the cursor from the lowest price of the most recent higher low to the highest price of this most recent higher high level. So by the time we connect the swing points with Fibonacci lines, you will notice that the Fibonacci retracement levels has been placed automatically by calculating the distance from the selected higher low to higher high level. Here you will notice 5 retracement levels where the 0 and 100 is not a Fibonacci ratio. But still, these levels are also important like the rest of the 3 Fibonacci levels. But our major concern should be only for 23.6, 38.2 and 61.8 Fibonacci retracement levels, since these are the most frequent levels where price changes their direction and hence retraced back towards the original trend direction. So these are the Fibonacci support levels where we will search long trade opportunities in this uptrend. Now, if I uncover some of the price actions of this chart, then you will notice that price went down and breaks the 23.6 Fibonacci retracement level. But still, the price is in the range of 30 exponential moving average line and as well as at the 38.2 Fibonacci retracement level. Now, if price break the 38.2 Fibonacci retracement level too and fall more down, then the 61.8 Fibonacci retracement level will work as the next support for this market correction period. So let's just wait and see if we can find any strong bullish candlestick pattern at this 38.2 Fibonacci retracement level to trigger long trade in this uptrend market. And as I uncover some more price action, then you can see that a strong bullish candle has formed above the 38.2 Fibonacci retracement level, and even the candle rises up by breaking the 23.6 Fibonacci retracement level and stays above that 23.6 Fibonacci level until the closing of the candle. So the 38.2 Fibonacci retracement level has worked here as the support for the sellers in this market correction period. So here the higher low level has been formed at the 38.2 Fibonacci retracement level. The bullish candles closing above the Fibonacci level and as well as above the moving average lines strengthen the validity of this higher low on this uptrend. So this price action pattern indicates that the retracement period is now over and the market is now ready to climb again towards the original trend direction. So we can now place long trade entry at the bullish candles closing and then set the stop loss at 38.2 Fibonacci level, since this is the lowest price of this higher low level, and then set the initial profit for at least 2 times the size of the stop loss. Now let's just wait and see if our profit target got hit or not. And as I uncover some more price action, then you can see that our profit target got hit as we had expected. Now, as you can see, a bearish candle has formed after a pin bar at this newly formed top or swing high point. So chances are huge that price will fall down after this bearish candle at the top. Now again, if we want to know the most probable retracement levels for this market correction period too, then let's draw the Fibonacci retracement levels again. So to draw the Fibonacci retracement levels, click the Insert tab on the top left corner of MetaTrader terminal. From here, select Fibonacci and then retracement. Now click and drag the cursor from the lowest price of the most recent higher low to the highest price of this most recent higher high level. Now as you can see, all the new Fibonacci retracement levels has been placed on the chart by calculating the distance of the selected swing high and swing low points. So let's just wait by letting the market run and see which Fibonacci level works as the next support for the retracement. So as I uncover some more price action, then you can see price falls all the way down to the 61.8 Fibonacci retracement level. In this run, price broke the 23.6 and 38.2 Fibonacci retracement levels. Now you will notice that a weak and unhealthy bullish candle has formed at this 61.8 Fibonacci retracement level. And also this bullish candle has formed above the 50 exponential moving average line. Although the 61.8 Fibonacci retracement level works as the Fibonacci support, but still you will notice that this 61.8 Fibonacci level is a market support from the previous resistance. So chances are huge that the market will find support and hence price will rise up from the 61.8 Fibonacci retracement level to continue the uptrend journey. But since we don't have any strong bullish candlestick pattern yet to confirm the bullish signal, let's just wait for more time to have a strong bullish candle to confirm the bullish momentum and hence trade long in this retracement level. And as I uncover some more price action, then you will see that a strong bullish candlestick has formed above the 61.8 Fibonacci retracement level as well as above the 50 exponential moving average line. You will also notice that even this bullish candle has closed by staying above the 38.2 Fibonacci retracement level and as well as above the 30 exponential moving average line. So this whole price action setup indicates nothing but strong bullish signal to trade long. So let's trigger long trade entry at the closing of the bullish candle, then set the stop loss at 61.8 Fibonacci retracement level and then set the initial profit for at least 2 times the size of the stop loss. Now that we are all done, let's just wait and see if our profit target got hit or not. And as I uncover some more price action, then you will see that our profit target got hit as we had expected and even price rose furthermore up. So that's how we can predict the most possible retracement level in an uptrend market by using Fibonacci retracement levels and validate a trade setup using swing trading strategy. Now open up your trading terminal and practice this Fibonacci retracement tool using old price action chart. I am pretty much sure that you are going to love this tool by the time you will discover the accuracy and beauty of Fibonacci price prediction levels in a price action chart. So that's all for today. In the next lecture, I will show you how to use the Fibonacci retracement tool to identify the most possible retracement levels in a downtrend market. So we'll see you in the next lecture. Until then, have a nice day and goodbye. Hello traders, welcome back. In the previous lecture, I have explained you about how to use the Fibonacci retracement tool in an uptrend market to predict the most probable retracement levels and have an extra level of trade confirmation signal along with swing trading strategy. Now in this lecture today, I will show you how to use the Fibonacci retracement tool in a downtrend market to predict the most probable retracement levels and have an extra level of trade confirmation signal along with the swing trading strategy. So let's start. Let's say this is a price action chart in a downtrend market where at the bottom or lower low level on this chart, a bullish pin bar has formed after the long bearish rally towards the downward direction. Now this bullish pin bar at this bottom indicates that the market is maybe going to rise up for price consolidation of the previous downward rally. But we don't know how far price will rise up, so to have the possible retracement levels, we will use the Fibonacci retracement tool. So to use the Fibonacci retracement tool, we will select the tool from our charting software and then drag it from the most recent lower high level to the most recent lower low level in the price action chart. And by the time you do that, you will see that at least 3 Fibonacci retracement levels will be placed on the chart by calculating the price distance from the selected lower high to lower low level. Here, these Fibonacci retracement levels will act as the resistance and hence will prevent price to go more up. Now, if price continues to rise up until the 23.6 Fibonacci retracement level and then a strong bearish candle appears at the 23.6 Fibonacci retracement level, then that means the sellers took control of the market over the buyers before price reached the next Fibonacci level. So we can place short trade entry at the closing of the bearish candle. Now if buying pressure remains strong during the market correction period and hence price rise more up by breaking the first Fibonacci retracement level, then the 38.2 Fibonacci retracement level will act as the second resistance level and will try to prevent price to go more up. So if you find a strong bearish candle at the 38.2 Fibonacci retracement level, then that would indicate that the sellers are getting stronger over the buyers and the market is now ready to fall again. So we can trigger short trade entry after the closing of the bearish candle at the second Fibonacci retracement level. Again, let's say if price continues to rise up by breaking even the second Fibonacci retracement level, then the 61.8 Fibonacci retracement level will act as the third resistance on this price consolidation rally. The buying pressure tends to lose its strength more often in this level if the downtrend continues for more time. So if you find a strong bearish candlestick pattern at the 61.8 Fibonacci retracement level, then you can consider this as the new lower high level of the downtrend from where price will fall again towards the original trend direction. So you can trigger short trade entry after the closing of the bearish candle at 61.8 Fibonacci retracement level. So that's the basic concept of trading short in a downtrend market by having the possible retracement levels using Fibonacci retracement tool. Now let me show you an example of using Fibonacci retracement tool in a real price action chart. As I open up a price action chart on the MetaTrader terminal, then you can see that this is a 4-hour chart of pound versus Swiss franc. Now, as you can see, the current market price is in here, where a strong bullish candle has formed at the bottom. So in this position of the market, we can assume that the market has started to rise up as price correction of the downward rally. Now, we don't know how far price will rise up to complete the market correction, so to identify the most probable retracement levels, we can use the Fibonacci retracement tool. So to have the Fibonacci retracement levels, click the Insert tab at the top left corner of MetaTrader terminal. From here, select Fibonacci and then retracement. Now we are ready to use the Fibonacci retracement tool on this chart. So click and drag the cursor from the most recent lower high to the most recent lower low level. After we connect the swing points with Fibonacci retracement tool, you will notice that the Fibonacci retracement levels has been placed automatically by calculating the distance of these selected swing points. So these are the Fibonacci retracement and as well as Fibonacci resistance levels. Now you will notice that price has already went up by breaking the 23.6 Fibonacci retracement level. But still we don't have any strong bearish candle to trade short. So let's wait for more time to see what comes next. Now if I uncover some more price action, then you can see that price rose up by breaking even the 38.2 Fibonacci retracement level. So still we don't have a strong bearish candle, which means the buyers are still controlling the market over the sellers. So we need to wait for more to have a strong bearish candle to confirm the lower high level, so that we can trigger short trade entry after that bearish candle. So if I uncover some more price action, then you can see that price rose more up until the 61.8 Fibonacci retracement level. Here a strong bearish candle has formed, followed by a long-legged spinning top candle by getting rejected by the 61.8 Fibonacci retracement level. So it's a signal that the sellers came back strongly over the buyers to continue the downtrend journey, which means the market has done making the correction of the previous bearish rally, and thus this is the most probable retracement level on this downtrend market. So we can consider this as a lower high level of this downtrend and hence can trigger short trade entry after the closing of this bearish candle. So let's trigger short trade entry at the closing of the bearish candle, then set the stop loss at 3 pips above the spinning top candle's high, and then aim for the initial profit for at least 2 times the size of the stop loss. Now if I uncover the rest of the price actions of this chart, then you can see that how nicely market has respected the Fibonacci retracement level and moved towards its original trend direction after getting rejected by the Fibonacci retracement level. So that's how we can use the Fibonacci retracement tool to identify the next possible lower high level where we can find the best short trade opportunity in a downtrend market. So that's all for today. Hope you guys enjoyed the lecture. I am signing off for now and we'll see you in the next lecture. Till then, have a nice day and goodbye. Welcome back traders, what's going on? In all of the previous lectures of this course, I used to look up for profit for at least 2 times the size of the stop loss by using the 1:2 risk and reward ratio model. That means, let's say this pin bar has formed at the higher low level in an uptrend market and we triggered a long trade entry at the closing of this pin bar. So according to pin bar and general trading method, we set our stop loss at 3 pips below the pin bar's low. So the distance from the entry position to stop loss position, we call this the size of the stop loss. And when we set our profit target, we look up for profit for at least the double size of the stop loss. That means according to the general rule of trading in a price action chart, we always set our profit target for at least 2 times the size of the stop loss using 1:2 risk and reward ratio model. But this profit targeting method is not always profitable when we trade the trends. Because in trend trading, most of the times you will need to increase your profit target and even sometimes you will need to shorten your targeted profit levels if price reach at a strong support or resistance level during its move towards the trend direction. So defining targeted profit levels using stop loss size is not ideal to trade in a trendy market. That's why from this lecture on to the next few lectures, I will show you another advanced method to predict the most possible profit levels so that you can minimize the risk and hence look forward to pre-predicted profit levels to book maximum profit from a trade using swing trading strategy. So the method we are going to use to predict the most profitable and risk-free profit target level is based on the famous Fibonacci price projection method. We will use the Fibonacci expansion tool to look up for profit target levels. Before I explain you the method with real chart examples, let me first tell you about the basic principle of Fibonacci expansion tool with graphical representation so that you can understand the basic ideas behind the setup and hence utilize the method with more accuracy in your trade setup. If you watched the previous lectures on advanced entry method using Fibonacci retracement tool, where I discussed about 4 of the popular Fibonacci levels that been used by the technical traders, then you already know that from these 4 Fibonacci ratios or the Fibonacci levels, we use at least 3 of the Fibonacci levels to detect the possible retracement levels in a price action chart. From these 4 Fibonacci levels, we do not use the 161.8 Fibonacci level to detect the probable retracement level. Rather, we only use 23.6, 38.2 and 61.8 Fibonacci level to predict the possible retracement levels. But on Fibonacci expansion tool, we will use 4 Fibonacci levels to predict the most probable profit levels in a trend. The first level is the 61.8 Fibonacci level. This is also called the golden ratio number. Then the second level is the 78.6 Fibonacci level. This is the square root of the golden ratio or 0.618 number. Then the third level is the 100 Fibonacci level. Although 0 and 100 is not a number which we can find by crunching the Fibonacci numbers, but still these numbers are equally valuable like the other ratios. And the fourth level is the 161.8 Fibonacci level. Now, among all the 4 Fibonacci levels, the 61.8 Fibonacci level will be our first profit target level or initial profit target level in Fibonacci expansion tool. Then the 78.6 Fibonacci level will be our second next profit target level for a trade. Then the 100 Fibonacci level will be our third profit target level, and then the 161.8 Fibonacci level will be our fourth profit target level in a trade. So these are the 4 Fibonacci levels on which we will look up to set our profit target after we trigger a trade in a trendy market. Now let's discuss about how to use the Fibonacci expansion tool to look up for most logical and as well as probable profit levels. Fibonacci expansion tool needs 3 points to define to give the price prediction levels, and the points are A, B and C. In an uptrend market, A is the previous bottom or higher low of the uptrend, B is the current top or higher high of the uptrend, and C is the current bottom or higher low of the uptrend. So after we define and draw these points in a price action chart using Fibonacci expansion tool, the Fibonacci price projection levels will be appeared in our chart automatically by calculating the distance of those 3 points on the chart. The exact same but opposite settings will be applied to predict the profit target levels in a downtrend market. Here A is the previous lower high level, B is the current lower low level, and C is the current lower high level on which we trigger short trade entry. So by the time we define these 3 levels, Fibonacci price projection levels will be placed on the chart automatically by calculating the distance of those 3 points on the chart. Now let's say you are in an uptrend market and you triggered a long trade entry after this pin bar. So if you want to know the most probable price projection levels using Fibonacci expansion tool, then you need to select the Fibonacci expansion tool from your charting software and then define the 3 most needed swing points in order to get the Fibonacci price projection levels. So if we click and define the 3 Fibonacci points using Fibonacci expansion tool, then the Fibonacci price projection levels will be placed automatically in the price action chart. Now notice that these Fibonacci levels are actually the Fibonacci resistance levels, which means these levels will resist price to go more up. That's why these are the levels where we will set our profit target, since price tends to change its direction by the time it reaches to a resistance level on a price action chart. On the same way, if this is a downtrend market and you triggered short trade entry at the closing of the bearish pin bar, then to look up for profit target levels, just select the Fibonacci expansion tool and then define the 3 required swing points on the chart. And by the time we do that, the Fibonacci price projection levels will automatically be placed in the chart. Here, the Fibonacci expansion levels are the Fibonacci support levels in this trade setup, which tend to act as price reversal points in a downtrend market. So these Fibonacci price projection levels are the levels where we will target to set our profit for the short trades in a downtrend market. In swing trading, we don't necessarily need to look up for market support and resistance levels to set the profit. Fibonacci expansion tool is more than enough to act as support and resistance for our trades in a trendy market. But sometimes we need to be aware about the very strong support and resistance levels in the market for better safety. But fortunately, Most of the times, Fibonacci expansion levels forms almost exactly at the same place as the market support and resistance levels. So that's the basic idea of the Fibonacci expansion setup in a price action chart. In the following lectures, I will show you how to use the Fibonacci expansion tool in real price action chart and predict the most probable profit levels in a trendy market. So we'll see you in the next lecture. Until then, have a nice day and goodbye. Welcome back, traders. In the previous lecture, you have learned about the basic concept of Fibonacci expansion tool with graphical demonstration. Now in this lecture today, I will show you how to use the Fibonacci expansion tool in real price action chart to set the targeted profit level in an uptrend market. So let's flip to the trading terminal. As I open up a price action chart in the MetaTrader trading software, then you can see that this is a 4-hour chart of euro versus dollar. Here you can see that the market is trending upward on this chart. Now here you will also notice that a bullish engulfing candle has formed above both the moving average lines and as well as above the 38.2 Fibonacci retracement level, which strengthen the validity of this swing point as a higher low of this uptrend. So let's trigger long trade after this bullish engulfing candle, then set the stop loss at 3 pips below the engulfing candle's low. Now what should be the targeted profit level for this trade? Well, we will use the Fibonacci expansion tool to see which levels we can consider to target as our profit for this trade. So to use the Fibonacci expansion tool on the MetaTrader terminal, click the Insert tab at the upper left corner. Then go to Fibonacci and from here click and select Expansion from the list. Now it's time to draw the Fibonacci expansion levels. So left click the cursor and drag from the previous higher low, which is the Fibonacci expansion point A, to current higher high point, which is Fibonacci expansion point B. And after we do that, you can see that a red dotted line has connected the previous top and bottom levels, and another red dotted line has been automatically been placed at 50% retracement of the point A and B, which is the Fibonacci expansion point C. You will also notice that the Fibonacci price projection levels also has been drawn on this price action chart. Now this Fibonacci expansion point C always been placed at 50% retracement of the previous rally by default. But retracements are not always fixed in the real market. Like here, price has retraced slightly lesser than the 50% of the previous rally. So to adjust this point, just double click and drag the Fibonacci point C to the actual lowest point of the current higher low level. After we do that, you will see that the Fibonacci price prediction levels has been changed and readjusted based on the price action we just defined by connecting the Fibonacci expansion points. Now as you can see, there are 4 Fibonacci price prediction levels in this chart. The first one is 61.8, the second one is 78.6, the third one is 100, and the fourth and last one is 161.8 Fibonacci expansion level. MetaTrader charting software has only 3 expansion levels by default, where we don't have the 78.6 Fibonacci expansion level. So to put that extra 78.6 Fibonacci expansion level on the chart, you have to configure it manually. To do that, just double click on the red dotted line so that the lines will be highlighted, then right click of your mouse on the highlighted red line. A new pop-up window will be open. From here select expansion properties. Then another pop-up window will be open. Here click the tab named Fibonacci levels. On here you can set the values of Fibonacci expansion levels. So click the add button to bring up a new level and then type 0.786 at the first field, and in the second field on the same row type FE 78.6. And we are done to set the 78.6 Fibonacci expansion level. Now click the OK button to finish the setup. Now, among all these 4 Fibonacci expansion levels, on which level should we target for the initial profit? Well, here's another trick. In my experience of swing trading, for larger retracements, target the higher Fibonacci expansion levels to set the initial profit. And for shorter retracements, target the lower Fibonacci expansion levels to set the profit. That means target the 61.8 and 78.6 expansion levels to set the profit if the retracement is less than 50% of the previous rally. On the other hand, target 100 and 161.8 Fibonacci expansion levels to set the initial profit if the retracement is more than 50% of the previous rally. So here as you can see, price has retraced slightly lesser than 50% of the previous rally, which is a decent retracement. Now, remember one thing very carefully, that the profit target should be set for at least 2 times the size of the stop loss. So, if we set the initial profit at 61.8 expansion level, then it would not give us 2 times profit than the stop loss size. And because the retracement is almost 50%, so 78.6 Fibonacci expansion level should be our first choice to set the profit, since it would give us more than 2 times profit against the stop loss size if we win the trade. Otherwise, we wouldn't be able to maintain at least 1:2 risk and reward ratio model for our trades. That means 78.6 Fibonacci expansion level is the best initial profit target for this trade. Now, if I uncover some more price action, then you can see that price rose up until the 78.6 Fibonacci expansion level, and then it turned back to fall down for the market correction of that bullish rally. So we booked almost 2.5 times profit against the stop loss size using Fibonacci expansion tool. Now let's move to the next trading point of this uptrend. If we delete the Fibonacci expansion levels that we just drew for the previous one, then you will notice that this higher low level has formed exactly at the same level as the previous higher low level. Price has retraced 100% of the previous rally, but price could not break the previous higher low level. That's why we can consider this bottom as the new higher low of this uptrend. Now let's say we triggered long trade entry after the closing of this bullish candle at this 100 retracement level by assuming that this is the new higher low of the uptrend and the market is going to rise again. And then we set the stop loss at 3 pips below the lowest price of the higher low level. Now to look up for the most probable profit levels for this trade, we will use the Fibonacci expansion tool again. So to use the Fibonacci expansion tool, just open up the tool by using the same method like the previous one, and then draw the Fibonacci expansion point A and B for this new price action pattern. So by the time we do that, you can see that the Fibonacci expansion point C has automatically been placed at 50% retracement level of the previous rally. But because the actual retracement is more than 50%, which is actually 100% in this case, we will adjust this manually by double click and dragging the Fibonacci point C to the lowest point of the higher low level. Now you can see that the Fibonacci expansion levels has been readjusted on the price action chart. Now as I mentioned before, that target the upper Fibonacci expansion levels for larger retracements, and since the retracement here is 100% and it is the highest level of retracement, so we should target the uppermost Fibonacci expansion level for our initial profit. Now here we should be aware about one thing, and that is 100% retracement is not good for a trend. Because let's say here this higher low has formed at the previous higher low level, and for that formation price dropped for a relatively large number. And if you notice, then you will see that even the moving averages overlapped each other, while the price actions of the higher low has formed below the moving average lines instead of forming above the moving average lines. Overall, this price action pattern shows the strength of the sellers on this uptrend market. So there's a good chance that the uptrend is maybe going to have an end in the near future. So our initial profit should be set at 78.6 or 100 Fibonacci expansion level. If we target 78.6 Fibonacci expansion level, then there's a good chance that we will win the trade and get more than 2 times profit than the stop loss size, even if the market can't make another high level, and hence the uptrend momentum ends in this run. We should close our 50% trades on 78.6 Fibonacci expansion level only if we find any strong bearish candle at that level. But if we do not find any strong bearish candle at the 78.6 Fibonacci expansion level, then we should not close any portion of our trade. Rather, we will wait for the 100 Fibonacci expansion level to be broken so that we can confirm that the market is heading towards the uptrend direction to make another higher level. So if price breaks the 100 Fibonacci expansion level, then there is a good chance that price will hit the 161.8 Fibonacci expansion level. So until we see any kind of strong bearish candle before 161.8 Fibonacci expansion level, we will target that 161.8 Fibonacci expansion level as our final profit level. Now let's wait and see if our initial profit target, which is 78.6, get hit or not. And as I uncover some more price action, then you can see that price hit the 78.6 Fibonacci expansion level. You will also notice that multiple numbers of different types of bullish and bearish candles has formed at this 78.6 Fibonacci expansion level. This indicates market indecision between the bulls and bears. But we don't see any kind of strong bearish candle on the 78.6 Fibonacci expansion level, which can indicate strong bearish momentum on the market. So we should not close any portion of our trade, rather we will wait for more. Now from this range, if price falls down by breaking the 61.8 Fibonacci expansion level, then that would indicate the end of the uptrend. And if price rise up and break the 100 Fibonacci expansion level, then that would indicate the continuation of the uptrend. So let's just wait for more and see in which direction the market ultimately goes. And as I uncover some more price action, then you will notice that price rose up. As you can see, this large bullish candle breaks the 100 Fibonacci expansion level. So it's a sign that the uptrend is going to continue for more time. So 161.8 Fibonacci expansion level is still our main profit target for this trade, and it's a valid profit target level in all the logical sense according to swing trading strategy. Now if I uncover rest of the price actions of this chart, then you can see how nicely price has moved towards the 161.8 Fibonacci expansion level, and then price changes its direction after hitting this level. We would have get 5 times profit than the stop loss size from this one single trade by the help of Fibonacci price projection tool along with this swing trading strategy. So that's how we can target the profit level using Fibonacci expansion tool after we trigger long in an uptrend market using swing trading strategy. I strongly believe that no tool in technical analysis can provide you such accurate and most probable profit levels in a trendy market except Fibonacci expansion tool. This is a must-have tool in my trading kit. Practice this tool using previous price action charts and make yourself more comfortable with this very useful price projection tool. So that's all for today. In the next lecture, I will show you example of using Fibonacci expansion tool in a downtrend market. So we'll see you in the next lecture. Till then, have a nice day and goodbye. Hello traders, welcome back. In the previous lecture, I have discussed about the usage of Fibonacci expansion tool in an uptrend market to predict the most possible profit levels after we trade long. Now in this lecture today, I will show you how to use the Fibonacci expansion tool in a downtrend market to predict the most possible profit levels after we trade short on that trend. So let's flip to the MetaTrader terminal. As I open up a price action chart in the MetaTrader trading terminal, then you can see that this is a 4-hour chart of Australian dollar versus Swiss franc. You will also notice that the market is trending downward on this chart. Now as you can see, this large bearish candle has formed after 2 back-to-back unhealthy bearish candles at the top of this 38.2 Fibonacci retracement level. Now after so many examples throughout this course, I don't think that I should tell you more about the significance of this bearish candle at this swing high point. This bearish candle at this position of the market clearly indicates the increasing selling pressure. So let's trigger short trade at the closing of this bearish candle, then set the stop loss at 3 pips above the highest point of the lower high level. And then to look up for the initial profit, let's bring up the Fibonacci expansion tool. So click the Insert tab at the top left corner of MetaTrader terminal, then go to Fibonacci, and from here from the list, select Expansion. Now let's draw the Fibonacci expansion points for this trade. So just click and drag the mouse cursor from the previous lower high level to current lower low level of the trend, and by the time we do that, you will notice that another red dotted line has been placed automatically at 50% retracement of the selected swing points. Now here the actual retracement is slightly lesser than 50% of the previous rally. So to set the Fibonacci point C at the right position, just double click on the red dotted line and then drag it to the exact retracement point. Now we are all done. Here you can see that our Fibonacci expansion levels also has been readjusted at the right position on this chart. Now which level should we target as our initial profit? As I mentioned in the earlier lecture that if the retracement is higher than 50%, then target the highest expansion levels such as 100 and 161.8 Fibonacci expansion levels. And if the retracement is less than 50%, then target the lower expansion levels such as 61.8 and 78.6 Fibonacci expansion levels. This method will give us the chance to book profits from the first attempt of the rally. Now since the retracement here is slightly lesser than 50% of the previous rally, So let's target the 78.6 Fibonacci expansion level to set the initial profit. Now let's just wait and see if our profit target get hit or not before the next retracement of the market. And as I uncover some more price action, then you can see that our profit target got hit and the market started to lose sellers at that 78.6 Fibonacci expansion levels. As you can see, a strong bullish candle has formed after the mess of some insignificant bullish and bearish candles at that level. It's an indication that price might be rise again for the market correction of the previous rally. So let's wait for more time to see what happens next. And as I uncover some more price action, then you can see that price rises more up from that 78.6 Fibonacci expansion level. As you can see, a strong bearish candle has formed, followed by a doji candle at the 80% retracement of the previous rally. So let's trigger another short trade after the closing of the bearish candle and then set the stop loss at 3 pips above the high of the doji candle. Now to look up for profit level, let's just bring up the Fibonacci expansion tool again. So click the Insert tab, go to Fibonacci, and then from here select expansion. Now repeat the same process like the previous one. Click and drag the cursor from the previous lower high level to current lower low level. So by the time we connect the required swing points with Fibonacci expansion tool, you can see that the Fibonacci expansion point C has automatically been placed at the 50% retracement level of the previous rally. And since the actual retracement is more than 50% for this trade, so let's just fix this manually by double click and dragging the expansion point C at the exact retracement point. So after we complete this setup, you will notice that the Fibonacci expansion levels has been readjusted on the price action chart. Now which level should we target as our initial profit for this trade? Notice that because this time the retracement is more than 50%, so we should target the 100 and 161.8 Fibonacci expansion level. Our main goal here is 161.8 Fibonacci expansion level. But before we achieve that kind of distance, let's just aim for the 100 expansion level. If we can find any kind of strong bullish candle at the 100 Fibonacci expansion level, then we will close our trade by assuming that the market has started to take another retracement again. But if we can't find any kind of strong bullish candle before 161.8 Fibonacci expansion level, then the 161.8 Fibonacci expansion level should be our main target to set the profit. So let's just wait for more and see what happens next. And as I uncover some more price action, then you can see that price dropped all the way down to the 100 expansion level, and still we don't see any strong bullish candle on this bearish rally. So it's a sign that the sellers are still controlling the market. Now let's wait again and see if our profit target, which is 161.8 Fibonacci expansion level, get hit or not. And as I uncover the rest of the price actions on this chart, then you can see that price went more down and hits the 161.8 Fibonacci expansion level. You will also notice that right after hitting the 161.8 Fibonacci expansion level, price changes its direction and moved up for another retracement on this market. Isn't it too much simple and awesome that price always respect the Fibonacci price prediction levels in a price action chart? These Fibonacci levels are always respected by the traders all over the world. So that's how we can predict the most probable profit levels for a trade using Fibonacci expansion tool. Now open up your trading terminal and practice this using old price action charts. So that's all for today. We'll see you in the next lecture. Till then, goodbye and have a nice day. Hello traders, welcome back. In this lecture today, I will tell you about the first type of trend confirmation with invalid swing points and more deep insight of the trend confirmation basics. So let's start. As you already know that when an uptrend forms and continues to rise towards the upward direction, it makes continuous higher highs and higher lows on that run, where every higher highs are the valid tops and every higher lows are the valid bottoms. To confirm an uptrend after a downtrend market, we need at least 2 higher highs and 2 higher lows to confirm the uptrend. And after we have the uptrend confirmation, we can go for long trade entries on every higher low points the uptrend creates. The exact same but opposite settings are applicable to confirm a downtrend after an uptrend market, where we need to have at least 2 lower highs and 2 lower low levels to confirm the downtrend. And then we can go for short trade entries in every lower high levels the market creates. So these are the basics of trend confirmation setup we need to know to trade in a trendy market, and you have learned all these things with detailed explanations in the previous section. Now let's say this is a price action chart in a downtrend market. From this position, if the market moves towards the upward direction from the current bottom level to make an uptrend, then this current bottom is the higher low level 1 and the top is higher high level 1 for the upcoming uptrend. And then the next bottom above the previous bottom level is the higher low level 2. Now these are all the valid tops and bottoms. As you can see, price moved up and down for a significant level of distance to make the swing points. But so many times in the market, you will be facing kinds of price action setup where multiple numbers of different directional candles will appear on the same row because of the market indecision between the bulls and bears for a long time. These are the situations where selling and buying pressure creates a neutral position on the market, and hence price consolidates by staying in a certain price range instead of going down to create a valid bottom or higher low level. And after some hours or day, market gets the energy to move as buying pressure increases for massive volume in size, so that price rises up to create a valid top level, and hence the uptrend continues its journey. But notice that this messy price consolidation or sideway range here, what will you name it? Higher high level 1 as top or higher low level 2 as bottom? Because price did stop here for some moments but did not went down for a significant level of distance to create a valid bottom, so that we can call the bottom as higher low level 2 and the top as higher high level 1. This is very important to know how to deal with these types of price action setup. And the reason is, let's say we do not consider it as a higher high level, nor we do consider it as a higher low level. So the next valid top level, we name it as higher high level 1, then the next valid bottom as higher low level 2, and then the next valid top level as higher high level 2. Now, by the time we have 2 higher highs and 2 higher lows in a price action chart, theoretically we got the confirmation of the uptrend according to swing trading strategy, as you already know that from the lectures on the previous section. So we can trigger long trade entry from this third higher low level, since third higher lows are the first trading point in an uptrend market according to swing trading strategy. But notice, to maintain the 2 higher highs and 2 higher lows rule to confirm an uptrend, we definitely missed some pips and trade opportunity here. Because by the time we get the uptrend confirmation, the trend has already made half of its journey. If we did not have the messy price consolidation here, let's say instead of this horizontal price consolidation, if we had a valid bottom here, then we could have confirmed the uptrend much earlier, so that we could have one more long trade opportunity in this uptrend. But the market does not move on our own wish, and these types of trade setups occurs more often in the real market. So how to deal with these kinds of trade setups? How can we have the trend confirmation a bit more earlier so that we can catch more trade opportunities from a trend which forms with these types of invalid swing points? Well, that's what we are going to discuss next. If from a bottom of a downtrend market, price goes up and breaks the previous top or lower high level of that downtrend, and then instead of coming down again to make another valid bottom level, price starts to consolidate in a certain price range so that it looks like a mess of some insignificant candlesticks on the chart, and then after that price consolidation, market gets the energy to move up and hence create a valid higher high and higher low level, and that valid higher low level, which is the higher low level 2, stays above the previous top of the downtrend. Then this valid bottom level or higher low level 2 confirms the uptrend if you can find a strong bullish candle at this higher low level. So if you find a strong bullish candle at that higher low level, then you got the confirmation of the new uptrend and hence can trigger a long trade entry on that second valid higher low level. You don't need to wait for the higher high level 2 in these types of price action setups to confirm an uptrend. So the position of the higher low level 2 above the previous top of the downtrend is sufficient to confirm an uptrend and hence gives the opportunity to trigger long trade entry. The exact same but opposite method will be applied to confirm a downtrend with invalid tops and bottoms. Let's say from the top or higher high level of an uptrend, price falls down to create a new bottom or higher low level, but from that bottom level, instead of price rising up to make a new higher high level, price starts to consolidate by staying in a certain price range so that it looks like some messy and insignificant candlesticks are there, which indicates nothing about the market momentum but neutral state or market indecision between the bulls and bears. And after some hours or day, sellers gets the strength in volume so that price falls down by breaking the previous bottom of the uptrend, and then creates another valid bottom level which we can call the lower low level 1, and then a new top or swing high level forms below the previous valid bottom of the uptrend. Then this price action setup will confirm the new downtrend of the market if you can find a strong bearish candle on that lower high level. So if you can find a strong bearish candlestick pattern on the second lower high level, then you can go for a short trade entry, because a strong bearish candlestick pattern on this position of the market means price declined to go up to continue the previous uptrend. That's why in these types of price action setup, 2 lower highs and 2 lower lows are not necessary to confirm the downtrend. But make sure that the lower high level 2 must form below the bottom of the previous uptrend, so that the previous bottom can act as a resistance level here for the current lower high level. So from now on, you can trigger short trade entries in every valid lower high level the market will create. That's how we can deal with the invalid tops and bottoms at the very beginning of a trend. In the next lecture, I will show you example of this trend confirmation method with real chart example. So we'll see you in the next lecture. Till then, goodbye and have a nice day. Welcome back traders, what's going on? This video is part 2 of type 1 in this section. In the previous lecture, I have explained you how to confirm an uptrend and a downtrend as early as it possible whenever invalid swing point forms at the top in a price action chart. The previous lecture was designed with illustrated examples of the setup, and from this lecture on to the next lecture, I will show you the setup with real chart example. So let's begin and discover the end of a downtrend and the beginning of an uptrend with invalid swing point step by step. As you can see, this is a 4-hour chart of silver versus US dollar. You will notice that the market is trending downward at the moment on this chart. You will also notice that the price is retracing upward for the market correction, where at the top of this retracement, we have a bearish engulfing candlestick pattern which signals the upcoming bearish momentum. Now, if I uncover some more price action, then you can see that price did not fall after the engulfing candle at the top, rather price rose up. That means the retracement is not over yet. So here price rejected to go down after the bearish engulfing candlestick pattern. Now as you can see, we have an inside bar candlestick pattern at the top where the inside bar candle is a small bearish candle. So there is a little chance that price will fall down by breaking the lower level of the inside bar pattern. So let's wait and see what the market brings us next. Now if I uncover some more price action, then you can see that price rose up and broke the upper level of the inside bar pattern. It's an indication that the retracement is not finished yet and the price will rise more up. But that doesn't mean that we will trigger long trade entry here, because we never trade long on a downtrend market. So we will wait for more to see if we can find any strong bearish candlestick pattern at the top of this retracement so that we can trigger short trade entry on this downtrend, since we're still in the downtrend market and there is no sign of the confirmation of an uptrend. So if I uncover some more price action, then you can see that price continued to rise more up, and again an inside bar candlestick pattern has formed at the top of the retracement. This inside bar pattern is stronger than the previous inside bar pattern. Now because the inside bar candle is a bearish candle again, so chances are high that price will fall down by breaking the lower level of this inside bar pattern. We will wait for the pattern to break to trigger short trade entry. But notice that price rose up by breaking both the moving average lines, while the moving averages are also changing their way of momentum from lower to higher direction. That's a sign that the downtrend is getting weaker by the time. So let's wait again and see what comes next. Now if I uncover some more price action, then you can see that price rises more up by breaking the upper level of the inside bar candlestick pattern. So again, price rejected to fall down to continue the downtrend. You will also notice that the moving averages overlapped each other, where the 30 exponential moving average line goes up by crossing the 50 exponential moving average line. That's another sign that the bullish momentum is getting stronger over the sellers. Now at the moment, at the top of this retracement, we have a long-legged bearish spinning top candle which signals bearish momentum. So if I uncover some more price action, then you can see that finally price fall down after the long-legged spinning top candle, but price got rejected again to fall more down, while the previous top of the downtrend acted here as the support for this bearish rally. The bearish rejection also can be seen with this long lower shadow of this bearish candle. And then the next candle, which is a bullish candle that engulfed the previous bearish candle, validates the weak selling pressure and hence strong bullish momentum on this price action chart. So overall, from the bottom of a downtrend market, price rose up by breaking the previous top. And on that run, multiple numbers of invalid swing points formed where every time price rejected to fall down after the bearish candlestick patterns, which indicates decreasing selling pressure on that downtrend. And by the time price got a pullback to continue the downtrend again, the buyers came back strongly where the previous top worked here as the support, and hence the formation of a bullish engulfing candlestick pattern at that support level indicates that the bearish momentum is over and the market is now under control of the buyers. So that's basically the indication of the end of the downtrend and the beginning of a new uptrend. Remember that we can't be 100% sure that the uptrend will continue, but still we need to take that risk to trade long by assuming that the downtrend is over and we are at the trading point of the new uptrend. We can never be 100% sure about the upcoming market momentum, but as a technical analyst, we have to do what is more logical and the market price action shows us to do. So in spite of the chance of losing a trade, we have to work with the market. So let's trigger long trade entry at the closing of the engulfing candlestick pattern on this newly formed uptrend market, then set the stop loss and take profit level using the same method as I showed you in the previous section. Now if I uncover the rest of the price actions of this chart, then you can see how nicely market has respected the new uptrend setup and rose in the upward direction. We could trigger more long trades at every next higher low levels the uptrend creates. So that's how we get the confirmation of an uptrend whenever we face the invalid swing points at the very beginning of the formation of an uptrend using the advanced swing trading strategy. Now open up your charting software and practice this price action setup so that you always know what exactly you have to do whenever you will have these types of price action setup in a price action chart. So that's all for now. We'll see you in the next lecture. Till then, goodbye and have a nice day. Welcome back traders, what's going on? This video is part 3 of type 1 in this section. In the previous lecture, I have explained you how to confirm an uptrend whenever invalid swing point forms at the top in a price action chart with real chart example. And in this lecture today, I will show you how to confirm a downtrend whenever invalid swing point occurs at the bottom on a price action chart. I will give you step-by-step explanation of the method with real chart example. So let's start. As you can see, this is a 4-hour chart of US dollar versus Canadian dollar. You will notice that the market is trending upward on this chart. And these are the two most recent higher low and higher high levels on this uptrend. You can see a bearish spinning top candle after a small pin bar at the top. This indicates increasing bearish momentum on the market. So there's a chance that price will fall down from this current higher high level to create another higher low level on this uptrend. So let's wait and see if that actually happened or not. So if I uncover some price action on the chart, then you can see that price falls down and retraced more than 90% of the previous bullish rally, though the previous rally was not that big in size. You will also notice that a strong bullish candle has formed at the bottom of this retracement, which might be the new higher low of the uptrend. So chances are high that price will rise up after this bullish candle to continue the uptrend. So let's wait again and see what comes next. If I uncover some more price action, then you can see that a bearish candle has appeared after the bullish candle at the bottom. This shows some selling pressure on the market. So let's wait again and see if price rise up or fall down after this bearish candle. Again, if I uncover some more price action, then you can see that price falls and hence another strong bearish candlestick pattern has formed which broke the current higher low level of the uptrend. That's not a good thing for the bullish traders, since a higher low breakout indicates the end of the uptrend in the near future. But still, there's a good chance that the buyers will come back strongly and hence the uptrend will continue its journey. But for that, the market needs a strong bullish candle to form. So let's wait again and see if we really can find a strong bullish candlestick pattern in this bottom or not. Now, if I uncover some more price action, then you can see that price continued to fall down more strongly. As you can see, another large bearish candlestick has appeared on this chart. Now, the most recent candle is a very small bullish candle, which though indicates some buying pressure on the market. So still, there's a hope for the buyers on the uptrend that the market will rise again after this bullish candle, because the uptrend is still valid and there is no downtrend confirmation signal came to the market yet. So let's wait again to see if the buyers can come back again with more strength or not. So if I uncover some more price action, then you will see that price did not rise up, rather price continued to fall more down. This time you will also notice that both the moving average lines overlapped each other, while the 30 exponential moving average line crossed the 50 exponential moving average line. Now at the bottom of this chart, the most recent candle is a strong bullish candle after two back-to-back unhealthy candles. This price action setup indicates the increasing buying pressure on the market. So still, there's a chance that the price will rise up and make another higher high level to continue the uptrend. But if we can find a strong bearish candlestick pattern below the current higher low level or below the moving average lines, then that would indicate the end of the uptrend and as well as the beginning of the new downtrend. So let's wait again and see if the buyers can pull up the market to continue the uptrend. Again, if I uncover some more price action, then you can see that price rises up but could not break and go above the moving average lines. Instead, two back-to-back unhealthy bearish candles formed at the top of the rally of the bullish candles below the moving average lines. These candles showing the market indecision between the buyers and sellers. In this stage, if we can find a strong bullish candle which break the moving average lines, then that would indicate the recharging of the buyers to continue the uptrend again. But if we see a strong bearish candle to form at this top level below the moving average lines, then that would confirm the end of the uptrend and as well as the beginning of a new downtrend at the same time. So let's wait and see what actually the market brings us here. So again, if I uncover some more price action, then you will see that a medium strength bearish candle has appeared below the moving average lines where the candle has an upper shadow which indicates the bullish rejection at the moving average line and hence signals the ultimate bearish momentum on this price action chart. So overall, price fall down for a relatively massive distance from the higher high level of the uptrend and broke the higher low level as well as the moving average lines. In that run, buyers tried several times to take control of the market, but sellers were so strong that price could not rise and continue the uptrend again. Later on, we see that buyers were in control for some times but could not break and rise above the moving average lines, since the sellers again came back strongly in the market to change the trend direction. So this whole price action setup indicates the end of the uptrend and as well as the beginning of a new downtrend on this market. Now, as I told you before, that we can never be 100% sure about an upcoming market momentum, rather we can only predict the most logical upcoming market momentum with our analysis. And here all the chart price action indicating the most probable upcoming bearish momentum on this market. So let's trigger short trade entry at the closing of the bearish candle, then set the stop loss and take profit levels using the same method as I showed you in the previous section. So now if I uncover the rest of the price actions of this chart, then you can see how nicely market has reversed after we confirmed the downtrend by using the advanced swing trading strategy for invalid swing points. We could have get the opportunity to trade every next lower high levels of this downtrend to trigger successful short trade entries. So this is how we can get the confirmation of a downtrend as early as it possible whenever we face the invalid swing points at the very beginning of the trend formation on a price action chart. Now open up your charting software and practice this price action setup. This way you can memorize the setup with the trading method and will be able to take appropriate trading decision whenever you will have these types of price action setup on your chart in the future. So that's all for now. We'll see you in the next lecture. Till then, goodbye and have a nice day. Hello traders, welcome back. This video is part 1 of type 2 of swing trading strategy for invalid swing points. From this lecture on to the next couple of lectures, I will show you another trend confirmation method for invalid swing points with the swing trading strategy. Before I explain you the method with real chart, let me introduce you the method and steps with illustrated examples like the previous lectures. So let's start. As you already know that when a trend forms, either it's an uptrend or downtrend, it continues its journey at its trending direction by making continuous swing points. We call these swing points in a downtrend market as lower highs and lower lows, and in an uptrend market as higher highs and higher lows. When an uptrend forms after a downtrend, price goes up by making continuous higher highs and higher lows, where we call the first swing point of this uptrend as higher low level 1, and then we name the rest of the other swing points by their numbered position. Now notice, until now in all our chart examples, we have seen valid higher low level as higher low 1, from which level we started counting the swing points of an uptrend. But not all the times in a price action chart of a market, uptrend starts with valid higher low level, so that you won't be able to start counting the next higher lows from that level to confirm the uptrend. And that price action setup have different strategy to make trade entries. Let's say we know that price goes up from valid higher low level to form an uptrend. But sometimes you will see that at the bottom level of a downtrend, before price rise to make an uptrend, price will retest that bottom level by making many candlesticks on that area instead of going up, so that it will look like the market is ranging at that level and not sure about the next move. What happened here is that these levels tend to be the oversold zone or a very strong support level where trade indecision occurs between the buyers and sellers. So the sellers try to push the price to bring it more down, and at the same time buying pressure grows stronger, so that price gets trapped in a certain price range for a long time. So it looks like an invalid bottom level which we can't name as higher low of the upcoming uptrend nor as lower low of the current downtrend. And then after retesting the level with multiple candlesticks for several hours or days and even for weeks, buyers take control of the market, and hence a big bullish candlestick appears and breaks that range. And after the range breakout happened by the buyers of the market, that time the rest of the sellers get to understand that the bearish momentum is over, the market is not going to breach that strong support level, so that the sellers close their trades and turn back into the buyers. So for that increasing buying pressure, price tend to go up and make a bullish rally towards the upward direction for a massive distance in the very first attempt. And then the uptrend continues by making higher highs and higher lows like it always does. The exact same but opposite price action setup you will see at the top of an uptrend before it went down to turn as a downtrend. At the top of an uptrend, when price reached to a certain price level, or say at a strong resistance level, you will see that price get trapped in a certain price range, so that many candlesticks will appear at that top level and the level will look like a mess with no indication of the next move. And then over time, selling pressure grows stronger in volume, and then finally sellers gets control over the buyers, so that one or two big bearish candles appears and break the lower level of the range. After the range is broken, price tend to fall down for a massive distance in the very first attempt. And then the downtrend continues its journey by making continuous lower highs and lower lows as usual. So for these types of trade setups, we should not wait for two valid swing points to have the trend confirmation. And that because price usually tends to go up or down for a massive distance in the first attempt after the range breakout happened. Also in this case, the first valid higher low in an uptrend market is not the right place to go for the first long trade entry, because still we definitely miss some pips of that long rally. Whenever these kinds of range-bound price action pattern occurs at the bottom of a downtrend market, the breakout of the range with a strong big bullish candle indicates the end of the current downtrend momentum and hence signals the upcoming uptrend. So we have to catch the trend and place long trade entry as early as it possible. The exact same but opposite scenario is applicable for short trade entries in a downtrend market. Range-bound price action setup at the top of an uptrend indicates the end of the uptrend, and then the breakout of that range with a big bearish candle confirms the upcoming downtrend. So how to catch and trade these types of price action setup in a more logical way so that we never miss a single pip? This is actually very easy. We need to apply the breakout strategy here. And that is, let's say this is a price action chart on a downtrend market, and at the bottom of this downtrend, price got stuck in a certain price range. This shows the trading indecision between the buyers and sellers. Now the downtrend will continue its journey if this range gets broken by a bearish candle towards the downward direction, because that will indicate that the sellers remained strong over the buyers. And if the range breakout happened by a strong bullish candlestick pattern towards the upward direction, then that would indicate the end of the downtrend and as well as confirm the beginning of a new uptrend. So let's say a strong big bullish candle formed at this range-bound market and hence broke the range completely towards the upward direction. So that means the buyers entered into the market with full strength over the sellers, and that confirms that the downtrend has ended up and the new uptrend has begun. So wait for the range breaking candle to close completely by staying above the sideways range, then place long trade entry after the closing of the range breaking candle. In these types of price action setup, never trade on a running candle. Always wait for the range breaking candle to close by staying outside of the range. Otherwise, false breakout is a common thing which can cause you to face unwanted losses. Now, after placing the long trade entry, set the stop loss at 3 pips below the low of the range breaking candle, or you can minimize the stop loss size if the range breaking candle is quite large in size. And then to look for the targeted profit levels, we will use the Fibonacci retracement tool instead of Fibonacci expansion tool for these types of price action setup. I will tell you more on that in the next lecture. So after the first trade at the range breaking candle, we can place long trade entries in every next higher low levels the uptrend will create. Apply the exact same but opposite method to confirm a downtrend for these kinds of price action setup. Let's say this is a price action chart in an uptrend market and price got stuck in a certain price range which might be at a strong resistance zone, and a bearish candle has just appeared and broke the range towards the downward direction. So if that happens, then that would indicate the rejection of the bullish momentum and will confirm the formation of a new downtrend. So wait for the bearish range breaking candle to close by staying below the lower level of the range. This is very important for a bearish candle to close below the range to make sure that the range has completely broken and hence the market momentum has changed. So after the trade entry, set the stop loss at 3 pips above the high of the range breaking candle. Again, if the candle is too large in size, you can reduce the stop loss to keep it minimal. And then to look up for profit target, use the Fibonacci retracement tool. You will learn more about that in the later lecture. Now, after the first short trade at the closing of the range breaking candle, we can place short trade entries at every next lower high levels the downtrend will create. So this is how we can identify these kinds of price action setup and hence catch and trade the trend at the very beginning of its formation in a price action chart. So that's all for now. We'll see you in the next lecture. Till then, goodbye and have a nice day. Welcome back traders, what's going on? This video is part 2 of type 2 in this section. In the previous lecture, I have shown you how to confirm an uptrend whenever the uptrend starts with invalid swing points at the bottom on a downtrend market, and as well as the confirmation method of a downtrend whenever the downtrend starts its journey with the invalid swing points at the top on a price action chart. The previous lecture was designed with illustrated examples of the setup, and from this lecture on to the next lecture, I will show you the setup with real chart example. So let's begin to know how to trade a downtrend for these kinds of invalid swing points step by step. If price gets trapped in a range-bound market at the top of a price action chart, and then after a few hours, days, weeks, or even month, a strong bearish candle appear and break the range from the bottom, and the range breaking candle closes by staying below the lower level of the range, then we will place short trade entry at the closing of the candle by assuming that the uptrend has ended up and the downtrend has begun. Then set the stop loss at 3 pips above the high of the range breaking candle, or if you want to be a little more conservative, then set the stop loss at 3 pips above the upper level of the sideways range. The knowledge of appropriate stop loss setting comes with experience, and there is no specific error-free rule to set the stop loss. So the stop loss should be set at the level where you think that the price will not go there unless the uptrend resumes again. But the ideal place to set the stop loss is the highest or lowest price level on a swing point depending on the market momentum. Now to target the profit level, we will use the Fibonacci retracement tool instead of Fibonacci expansion tool. And the reason is, as you already know from the previous section, that to calculate the Fibonacci expansion levels, we need 3 swing points in a price action chart to define the Fibonacci point A, B, and C in order to get the Fibonacci price prediction levels for a specific trade where the Fibonacci expansion levels work as the take profit levels. But for these kinds of price action setup, we don't have the Fibonacci point C since we don't have any swing points of the downtrend like the lower highs and lower lows because of the sudden change of the trend momentum. So we will use the Fibonacci retracement tool, which is almost perfect for these kinds of price action setups to target the most probable profit levels. So we will select the Fibonacci retracement tool from our charting software and then drag it from the most recent higher low of the uptrend, which is Fibonacci point A, to the highest price level of the range bound pattern, which is Fibonacci point B. And by the time we connect these 2 points, the Fibonacci retracement levels will be placed automatically in the chart. In most of the charting software, you will have 3 default Fibonacci retracement levels, which is 23.6, 38.2, and 61.8 Fibonacci retracement levels, except the 0 and 100 in the list. But for these kinds of price action setup, we will not use these levels. Rather, we will use the next 4 Fibonacci retracement levels, which is 78.6, 100, 123.6, and 161.8 Fibonacci retracement level to target as our initial profit level. From these 4 levels, to choose the initial profit, start from the 78.6 Fibonacci level if that level gives you at least 2 times profit than the stop loss size. But if the 78.6 level is shorter in size to achieve 2 times profit than the stop loss size according to 1:2 risk and reward ratio model, then choose the 100 Fibonacci level for the initial profit and so on. But I personally prefer to go with the 123.6 Fibonacci retracement level to target as my first initial profit level for these kinds of price action setup. So that's the basic idea of trading these kinds of price action setup on a newly formed downtrend market with invalid swing points. Now let me give you an example of this setup using real price action chart. So let's flip to the MetaTrader trading software. As you can see, this is a 4-hour chart of Euro versus US dollar. I made the rest of the price actions of this chart hidden and will display part by part as I explain you the steps further ahead. Now you can see that the market is trending upward on this chart, and also you will notice that in this chart the current price is at the top of the bullish rally on this uptrend. Now if I uncover some more price action to see what happened for next few days, then you will notice that price, without rising more up or falling down, it got stuck in a certain price range and retesting that level for more than 8 trading days. This sideways range shows up the market indecision between the buyers and sellers. No group is able to decide the next move of the market from here. That might be the reason of a strong resistance level or the release of an upcoming economic news. No matter what the reason is, we should not bother. We should just wait to see the breakout of this range, since breakout of this range in either way will decide the next move of the market. So if price rises up by breaking the upper level of the range, then that would indicate the continuation of the running uptrend. But if price breaks the lower level of this range bound pattern, then that would indicate the end of the uptrend and signal the beginning of a new downtrend. We should not trigger any kind of long or short paid entry here before the next signal. So let's wait again and see in which direction the price ultimately breaks the range. Now if I uncover some more price action, then you will come to see that a big bearish candle has appeared which broke the lower level of the range and even stayed below that lower level when the candle closed, which confirms the complete breakout of this range-bound pattern at the top of this uptrend. So this bearish candle is well enough to speak about the change of the market momentum. Now notice that price may rise after this bearish candle and resume the uptrend again. But most often, this doesn't occur after the breakout of these kinds of range-bound pattern at the top of an uptrend. So this whole price action setup signals nothing but increasing bearish momentum on the market. So let's trigger short trade entry at the closing price of the range-breaking candle. Remember that never trade in a running candle for these types of range breakout of the market, since fake breakout is very common in a price action chart. And then set the stop loss at 3 pips above the high of the range breaking candle, and to look up for the initial profit, we will use the Fibonacci retracement tool. So to use the Fibonacci retracement tool, just click the Insert tab at the top left corner of the MetaTrader terminal, then go to Fibonacci, and from here select retracement, and we're all done. Now click and drag from the previous higher low of the uptrend to the highest price level of the range bound pattern. And by the time we do that, you will notice that the Fibonacci retracement levels has automatically been placed on the chart. Now, like on this chart, you may not see 78.6 and 123.6 Fibonacci levels on your Fibonacci tool. You may need to manually add these levels by your own. It's very easy, and I showed you the process in the previous section. Now, which level should we target for the initial profit? Notice that since the range breaking candle is quite large, and hence the stop loss size is also relatively huge in this case, so to achieve 2 times profit than the stop loss size to maintain the 1:2 risk and reward ratio model, we have to look for a larger profit level. So definitely we can't choose the 78.6 and 100 Fibonacci retracement levels for this trade. Instead, if we target the 123.6 Fibonacci retracement level or the 161.8 Fibonacci retracement level to set the profit target, then that would bring us at least 2 times or more profit from this trade against this stop loss size. So let's start from the 123.6 Fibonacci retracement level to set the profit. Now let's wait again and see if the downtrend actually remains strong and hence the price continued to fall down. So if I uncover the rest of the price actions of this chart, then you can see that price went down as the downtrend continued its journey, and of course our profit target got hit as we had expected. So that's how we deal with these types of range bound pattern at the top of an uptrend and trade short at the very first moment the downtrend forms in a price action chart. We could have triggered more short trade entries for several more times at the lower high levels of this newly formed downtrend market. So open up your charting software, find and practice these types of price action setups using previous chart history so that you will no longer hesitate to take appropriate trading decision whenever you will face these kinds of market situations. So that's all for now. We'll see you in the next lecture. Till then, goodbye and have a nice day. Hello traders, welcome back. This video is part 3 of type 2 in this section. In the previous lecture, I have shown you how to confirm a downtrend whenever the downtrend starts its journey with the invalid swing points at the top on a price action chart. And in this lecture today, I will show you the uptrend confirmation as well as the trading method with the invalid swing points at the bottom on a price action chart. So let's start. If the price gets trapped in a range-bound market at the bottom on a price action chart, and then after a few hours, days, weeks, or even month, depending on the time frame, a strong bullish candle appear and break the range from the top, where the range breaking candle closes by staying above the upper level of the range, then we will place long trade entry at the closing of the range breaking bullish candle by assuming that the downtrend has ended up and the new uptrend has begun. And then we will set the stop loss at 3 pips below the low of the range breaking candle or below the lowest price of the range bound pattern if the pattern is shorter in distance, so that our stop loss wouldn't get hit from the sudden spike of the market. Now to target the profit level, we will use the Fibonacci retracement tool instead of Fibonacci expansion tool. In the previous lecture, I explained you the reason behind using the Fibonacci retracement tool for these types of price action setup. So we will select the Fibonacci retracement tool from our charting software and then drag it from the most recent lower high of the downtrend, which is Fibonacci point A, to the lowest price level of the range-bound pattern, which is Fibonacci point B. And by the time we connect these 2 points, the Fibonacci retracement levels will be placed automatically in the chart. For these types of price action setup, where we use the Fibonacci retracement tool to predict the upcoming price levels to set the initial profit, we don't use the default Fibonacci retracement levels, which are the 23.6, 38.2 and 61.8 Fibonacci retracement levels. Rather, we use the higher Fibonacci retracement levels, which are the 78.6, 100, 123.6 and 161.8 Fibonacci retracement levels to target these levels to set the profit. Now from these 4 levels, to choose the initial profit, start from the 78.6 Fibonacci level if that levels gives you at least 2 times profit than the stop loss size. But if the 78.6 level is shorter in distance to achieve 2 times profit than the stop loss size according to 1:2 risk and reward ratio model, then choose the 100 Fibonacci level for the initial profit. And still, if the 100 Fibonacci retracement level becomes shorter relative to the stop loss size, then set the 123.6 Fibonacci retracement level to set the initial profit and so on. Remember that we need to set the initial profit for at least the double size of the stop loss size to maintain the standard money management rule. That means if the stop loss size, which is the difference of the trade opening price and stop loss setting price, is 50 pips, then we have to target for at least 2 times the size of the stop loss size, and that is 100 pips. So that's the basic idea of trading these kinds of price action setup on a newly formed uptrend market with invalid swing points. Now let me give you an example of the setup using real price action chart. So let's flip to the MetaTrader trading software. As you can see, this is a 4-hour chart of US dollar versus Swiss franc. And you will notice that there is a downtrend momentum running on this chart where the current bottom level is the lower low level of this downtrend. Now if the downtrend wants to continue from this position of the market, then it will need to make new lower highs and lower lows towards the running trend direction. Now let's wait and see if the market can make another lower high level from where it will move again towards the downward direction to continue its original trend. So if I uncover some price action on the chart, then you can see that price did not rise up for a standard distance to create a very lower high level, nor does it fall down towards the downward direction to continue the trend. Rather, price got stuck in a certain price range for a long time, which now looks like a range-bound pattern at the bottom on this downtrend. So this whole range-bound pattern indicates the market indecision between the buyers and sellers. It's a sign that the downtrend might be going to have an end if the buyers can break the range from the top. But if the sellers can gather more selling pressure in volume for which the range-bound pattern will be broken from the bottom, then that would indicate the continuation of the current downtrend. So let's wait again and see in which direction the range-bound pattern ultimately get broken. So if I uncover some more price action, then you can see that a large bullish candle has formed which broke the upper level of the range-bound pattern at the bottom on this downtrend. Also, the range-breaking candle closes by staying above the upper level of the range. Now notice that there is a chance that after the breakout of the upper level of the range-bound pattern, price will fall down towards the downward direction without making an uptrend. But most often, whenever we see these kinds of range-bound pattern at the bottom on a downtrend market, then the breakout of the upper level of the range-bound pattern simply indicates the end of the downtrend as well as confirms the beginning of a new uptrend. So we have to take the risk to trade the market by assuming that the uptrend has formed whenever the price breaks the upper level of the range. So here, the breakout of the upper level of the range-bound pattern gives us the signal that the downtrend has ended up and a new uptrend has begun. So let's trigger long trade entry at the closing price of the range-breaking candle, then set the stop loss at 3 pips below the previous bearish candle to avoid the sudden spike of the market. And then to target the profit levels, we will use the Fibonacci retracement tool. So click the Insert tab at the top left corner of the MetaTrader terminal, then go to Fibonacci and from here select Retracement. Now to draw the Fibonacci retracement lines, click on the most recent lower high of the downtrend, then drag it to the lowest price of the range-bound pattern and release the mouse. So by the time we connect the Fibonacci retracement points, you can see that the Fibonacci retracement levels has automatically been placed on the chart. Here we will use the Fibonacci retracement levels to set the profit. To look up for at least 2 times profit than the stop loss size, if we target the 78.6 Fibonacci level, then that would not give us 2 times profit than the stop loss. Rather, the 100 and the higher Fibonacci levels are good places to target for the profit, since that would bring us more than 2 times profit than the stop loss size. But in my personal preference, I like to use the 123.6 Fibonacci level to set the initial profit for these types of price action setup. So let's target the 123.6 Fibonacci level to set the initial profit for this trade and wait to see if our profit target get hit or not. So if I uncover the rest of the price actions of this chart, then you can see that price rose up and hit the take profit level on 123.6 Fibonacci level, which is more than 200 pips in this one single trade. We could have triggered more successful long trade entries at every next higher low levels on this newly formed uptrend market. So that's how we can confirm the end of a downtrend as well as the beginning of a new uptrend whenever we will face these types of range-bound pattern at the bottom on a downtrend market. So practice this price action pattern using the old chart history and make yourself an expert of trading the trends even if the trend is full of invalid swing points. So that's all for now. We'll see you in the next lecture. Till then, goodbye and have a nice day. Welcome back, traders. What's going on? In the previous lectures of this section, I talked about the trend confirmation method for invalid swing points. And from this lecture on to the next few lectures, I will talk about the trading method of invalid swing points at the trading point of a trend. So let's begin to the first lecture of this type, where I will give you the basic idea of the kind of price action setup where invalid swing point forms at the trading point of a trend. As you already know that when a trend forms, either it's an uptrend or downtrend, it continues its journey at its trending direction by making continuous swing points. We call these swing points in a downtrend market as lower highs and lower lows, and in an uptrend market as higher highs and higher lows. In terms of swing trading strategy, in a downtrend market, the lower highs are the trading points of the downtrend, and on the other hand, in an uptrend market, the higher lows are the trading points of that uptrend. You already know that when an uptrend forms, we wait for 2 back-to-back higher highs and higher lows for the confirmation of that uptrend. And after we get the confirmation, we wait for the third higher low to form and search a strong bullish candlestick pattern at that higher low level to trigger the first long trade entry, since the third higher low level is the first trading point of an uptrend. Then the upcoming higher lows are the next trading points. And generally, we get strong bullish candlestick pattern at the very higher low levels from which price rises up towards the upward direction. But most often, you will see that in some higher low levels, price will get stuck in a certain price range so that many different directional candlesticks will appear on that range, which indicates the trading indecision between the bulls and bears. Here, sellers try to push the price to bring it more down, while at the same time, buyers on the other hand tries to pull up the price to continue the uptrend again. So for the impact of this whole market indecision between the buyers and sellers causes price to stay in a certain price range for a long time depending on the time frame. And then after the appearance of several candlestick patterns at the same row, finally buyers come back strongly, hence the price get broken from the top, while that breakout indicates the upcoming strong bullish momentum, which is why price tend to rise up after the breakout of the upper range of the range-bound pattern at the higher low level, and hence the uptrend continues its journey. Now notice that although we are calling this range-bound pattern as invalid swing point, but it is actually a valid higher low level, because already price has retraced for a standard distance, then the range-bound pattern forms at the bottom level of the retracement. So we will consider this as a valid higher low level and we'll look up for the breakout of the upper range of the range bound pattern to trigger long trade entry. On the same way, often you will see invalid swing points at the lower high level in a downtrend market where without price falling down after a strong bearish candle, instead price will retest a certain price level for a long time, which is the result of the equal pressure from both the buyers and sellers, as because no groups are sure if the price will retrace for more time and distance. And then finally, the sellers of the market wins over the buyers as the price breaks the lower range of the range-bound pattern, after which price falls down towards its original trend direction to continue its downtrend journey. So that's the basic idea of how an invalid swing point at the trading point will look like in a trendy market, either it's an uptrend or downtrend in a price action chart. In the next lecture, I will give you detailed explanation of trading these types of invalid swing points at the trading point in a trendy market with real chart example. So till then, have a nice day and goodbye. Hello traders, welcome back. This video is part 2 of type 3 in this section about trading the invalid swing point at the trading point of a trend. In the previous lecture, I showed you the basic details of the price action setup of invalid swing point at the valid high-low level in an uptrend market, as well as the invalid swing point setup at the lower high level in a downtrend market. Now in this lecture today, I am going to show you how to trade long in an uptrend market whenever invalid swing point forms at the valid high-low level in that uptrend using real price action chart. Before I give you example using real price action chart, let me first introduce you the steps with illustrated example. So let's start. After we confirm the formation of an uptrend, then in any of the next higher-low level, if the price gets trapped in a certain price range and stay there for a long time depending on the time frame, then that would indicate the market indecision between the buyers and sellers. Here, the demand and supply volume of a security tend to be equal in both sides. So we will have to wait for the breakout of this range-bound pattern to take any appropriate trading decision. That means if the price breaks the lower range of the range-bound pattern, then that would indicate the continuation of the retracement and will not give any signal to trade long, neither has it given the signal of the end of the trend, rather it simply means that the market is not ready yet to rise up again to continue the uptrend. So let's say if the price breaks the range-bound pattern from the bottom at the 50% retracement level and fall more down to the 90% retracement level of the previous rally, and then a strong bullish candlestick pattern appears at that level, then we can trigger long trade entry by assuming that the market correction is over, hence the price is going to rise again towards the upward direction. But let's say if the price breaks the upper range of the range-bound pattern at the 50% retracement level, while the range-breaking candle closes by staying above the range-bound pattern, then that would indicate the end of the market correction, since the pattern break from the top indicates the upcoming bullish momentum on that uptrend and hence signals to trade long. So we will trigger long trade entry at the closing of the range-breaking candle, then set the stop loss order at 3 pips below the range-breaking candle, or if the range-breaking candle is small in size, while the range-breaking pattern is also shorter in distance, then we will set the stop loss at 3 pips below the range-bound pattern. Adjust the stop loss at that level where you think the price will not come back if the price ultimately goes at the trading direction. And then to target for the profit, use the Fibonacci expansion tool. So select the Fibonacci expansion tool from the charting software and then drag it from the Fibonacci point A, which is the previous higher-low level, to the Fibonacci point B, which is the current higher-high level, and then adjust the Fibonacci point C at the exact retracement level, which is the current higher-low level. So by the time we connect the Fibonacci expansion points, the Fibonacci price prediction levels will be placed automatically in the chart. Here, choose the Fibonacci expansion levels or price prediction levels to target for the initial and further profit levels by using the method I showed you in the earlier section. Now notice that multiple numbers of invalid swing point or range-bound pattern can be formed at the higher-low levels in an uptrend market, where we will apply the same strategy to trade the invalid swing point. So that's the basic rule of trading an invalid swing point at the valid higher-low level in an uptrend market. Now let me give you an example of this setup using real price action chart. So let's flip to the MetaTrader trading software. As you can see, this is a daily chart of Australian dollar versus Canadian dollar. You can see that the market is in the uptrend momentum in this chart, as of it has at least two back-to-back higher highs and higher lows. Now you will also notice that the current market price is on a valid higher low level in that uptrend, where you can see a strong bullish candlestick pattern after a small bullish pin bar with bearish head. The closing of the bullish candle is above the moving average lines, which gives a very strong signal to trigger long trade entry. So let's say you triggered long trade entry at the closing price of the bullish candle, then set the stop loss at 3 pips below the pin bar's low. Now let's wait and see if the price continues to rise up or not from this position of the market. So if I uncover some price action of this chart, then you can see that the price did not rise up after that bullish candle, neither does it fall down to retrace for more. Rather, price got trapped in a certain price range for more than 2 trading weeks, while many different directional candlesticks has formed above the moving average lines. The price ranging in this range-bound pattern indicates the trade indecision between the bulls and bears. So the breakout of this range will decide the next move of the market. Now notice that since you traded the first bullish candle at the very beginning, which was a valid trade entry, so don't close that trade by just watching this range-bound pattern of the market, because most often these range-bound patterns at the higher-low level in an uptrend tend to be broken from the top. So still there's a chance that the price will rise up to continue the uptrend, but never trigger another trade entry in this range-bound pattern. As you can see, the most recent candle in this range-bound pattern is a strong bullish candle, but this candle is not worthy to give the final signal or confirmation to trade long. Just wait for the range-bound pattern to be broken from the top. So let's wait again and see in which direction the pattern ultimately got broken. So if I uncover some more price action of this chart, then you can see that price did not rise up to continue the uptrend again. Rather, price remained to stay in the range-bound pattern at this higher-low level. So still we can't see any strong indication of the next market move. So let's just wait again for more time and see what happens next. So now if I uncover some more price action on this chart, then you can see that the market finally gets some volatility from the buyers, which is why price rose up and break the upper range of the range-bound pattern at this higher-low level. And that's the final signal that the market is going to rise up, as because the buyers took control of the market after a long fight with the sellers for more than 3 trading weeks. So if you could not trigger the first long trade entry before the price went to the cage, then this breakout of the range-bound pattern gives you the opportunity to trade long at this high-low level. So let's trigger long trade entry after the closing of the range-breaking candle, then set the stop loss at 3 pips below the 50 exponential moving average line, since the moving averages work as dynamic support level and the support levels are the best places to set the stop loss for long trade entries. And then to target the profit levels, we will use the Fibonacci expansion tool. So click the Insert tab at the top left corner of the MetaTrader terminal, then go to Fibonacci, and from here select expansion from the list. Now to draw the Fibonacci expansion levels, just click and drag your mouse from the previous higher low to current higher high level and release the mouse. Now as you can see, the retracement here is more than 50% of the previous bullish rally. So to adjust the Fibonacci point C, just double click on it and then drag it to the exact lowest price of the retracement, which is the pin bar low in this higher low level. Now you can see that the Fibonacci price prediction levels has been readjusted on the chart. So we will choose these Fibonacci expansion levels to target the profit. For this trade, to maintain at least 1:2 risk and reward ratio model, the 100 Fibonacci expansion level is the minimum price level, which will give us at least 2 times profit than the stop loss size. or we can target the 123.6 expansion level to set the initial profit, and so on. Now after we do all the settings, let's just wait again and see if the uptrend really continues or not after the breakout of the range-bound pattern at the higher-low level. So if I uncover the rest of the price actions of this chart, then you can see that the price rose up and hit the targeted profit level as we had expected. So that's how we can manage our trading decisions whenever we will have these types of invalid swing points or range-bound pattern at the higher-low level in an uptrend market. So practice this price action setup using old chart history to become more familiar with this setup. Do not hurry and aggressive to trade the market. Always wait for the exact signal to trade, even if you need to wait for a month to have a valid trade signal. Patience always pays the best reward. So that's the end for now. We'll see you in the next lecture. Till then, have a nice day and goodbye. Welcome back traders, what's going on? This video is part 3 of type 3 in this section about trading the invalid swing point at the trading point of a trend. In the previous lecture, I showed you the method of trading the invalid swing points at the trading point or higher-low level in an uptrend market. Now in this lecture today, I am going to show you how to trade short in a downtrend market whenever invalid swing point forms at the valid lower high level in that downtrend using real price action chart. Before I give you example using real price action chart, let me first show you the steps with illustrated example. So let's start. After we confirm the formation of a downtrend, then in any of the next lower high level, we always look for a strong bearish candlestick pattern at the lower high levels to trade short, because price tend to go down from the lower high level of a downtrend market. But if the price get trapped in a certain price range at the lower high level on a downtrend market and stay there for a long time depending on the time frame, then that would indicate the market indecision between the buyers and sellers. So we will have to wait for the breakout of this range-bound pattern to take any appropriate trading decision. So if the price breaks the lower range of the range-bound pattern at the very lower high level, while the range-breaking candle closes by staying below the range-bound pattern, then that would indicate the end of the market correction, since the pattern break from the bottom indicates the upcoming bearish momentum on that downtrend and hence signals to trigger short trade entry. So we will trigger short trade entry at the closing of the range breaking candle. Then set the stop loss at 3 pips above the range breaking bearish candle, or we will adjust the stop loss depending on the price action setup. That means if the range bound pattern is shorter in distance, then we will target the highest price of the lower high level, or we will set the stop loss at the moving average line, since the moving averages act as the dynamic resistance in a downtrend market. And then to target for the profit, we will use the Fibonacci expansion tool. So select the Fibonacci expansion tool from the charting software and then drag it from the Fibonacci point A, which is the previous lower high level, to the Fibonacci point B, which is the current lower low level, and then adjust the Fibonacci point C at the exact retracement level, which is the current lower high level in the downtrend. So by the time we connect the Fibonacci expansion points, the Fibonacci price prediction levels will be placed automatically in the chart. Here we will choose the Fibonacci expansion levels or price prediction levels to target for the initial and further profit levels. So that's the basic rule of trading an invalid swing point at the valid lower high level in a downtrend market. Now let me give you an example of this setup using real price action chart. So let's flip to the MetaTrader trading software. As you can see, this is a 4-hour chart of pound versus Aussie dollar. You can see that the market is in the downtrend momentum on this chart. You will also notice that the current market price is on a very lower high level in that downtrend. Price has retraced 50% of the previous bearish rally. So if we can find a strong bearish candle at this position of the market, then that would signal the end of the market correction and hence signal to trade short. Now let's just wait for more time to see if we can find a strong bearish candle to trigger short trade entry. So if I uncover some price action on this chart, then you can see that the price has started to ranging in this lower high level instead of going down to continue the downtrend. So many different directional candlestick has formed in this range-bound pattern. These candles are very weak to give any specific direction of the next market move. The moving average lines working here as the resistance level, as you can see that the price got rejected for several times to break the moving average lines. So chances are high that we will see the range-bound pattern to be broken from the bottom so that the downtrend will continue again. But still, before we get the final confirmation, we should not trigger short trade entry. So let's just wait again and see in which direction the pattern ultimately get broken. And as I uncover some more price action, then you can see that the price broke the lower range of the range-bound pattern as of two back-to-back bearish candle has formed at this lower high level. This breakout of the range-bound pattern simply indicates the increasing selling pressure from the sellers of the market. So this is the final confirmation of the upcoming bearish momentum of the downtrend. So let's trigger short trade entry at the closing of the range breaking candle. Then to set the stop loss for this trade, we should not set it at 3 pips above the range breaking candle like we always does, because the range breaking candle is not that big in size. So we will have to make the stop loss a bit more far away so that the stop loss wouldn't get hit from any sudden spike of the market. So we should set the stop loss at 3 pips above the 30 exponential moving average line or at the top of the range bound pattern. This is a relatively risk-free zone from any sudden spike of the market. Now to set the profit target, we will use the Fibonacci expansion tool. So click the Insert tab at the top left corner of the MetaTrader terminal, then go to Fibonacci and from here select expansion from the list. Now to draw the Fibonacci expansion levels, just click and drag your mouse from the previous lower high to current lower low level. And then to adjust the Fibonacci point C, just double click on the line, then drag it to the highest price of the range bound pattern, and we're all done. Now you can see that the Fibonacci price prediction levels has been readjusted on the chart. So we will choose these Fibonacci expansion levels to target the profit. For this trade, to maintain at least 1:2 risk and reward ratio model, the 100 Fibonacci expansion level is the minimum price level which will give us at least 2 times profit than the stop loss size. Or we can target the 123.6 Fibonacci expansion level to set the initial profit and so on. Now after we do all the settings, let's just wait again and see if the downtrend really continues or not from this position of the market. So if I uncover the rest of the price actions of this chart, then you can see that the price falls down and hit the targeted profit level as we had expected. So that's how we can manage our trading decisions whenever we will have these types of invalid swing points or range bound pattern at the lower high level in a downtrend market. Now open up your charting software, find and practice these types of price action setups using previous chart history so that you will no longer hesitate to take appropriate trading decision whenever you will face these types of invalid swing points at the trading point on a price action chart. So that's the end for now. Hope you enjoyed the lecture. We'll see you in the next video. Till then, have a nice day and goodbye.
Thanks for watching. Don't forget click the subscribe button and hit the bell icon. Like, comment and share. See you next time.